All right. Good morning, everybody. I think it's time to get started here. Welcome to the FASB here in Norwalk for another meeting of the Credit Losses Transition Resources Group. Just as a reminder to everyone, this is being audio and video webcasted. And if you notice in the middle of the room, there are 8 high-definition cameras focused on you. Please don't let that intimidate you in any fashion. Comb your hair, guys. Okay. So I think it's important, though, that, just a couple of rules of the road. As we're talking, we're going to be calling on individuals. You've all been through this before. Just remember, turn on the mics, speak closely into the mics to make sure that all the audio is being picked up, and then turn it off at the end. So we're going to have a little bit of practice. I'm going to start with my name and affiliation, Hal Schroeder, FASB, and I'm going to start to my left with Shane.
Shane Kahanick, FASB staff.
Sue Cosper, FASB staff.
Seth Drucker, FASB staff.
Jared Klein, FASB staff.
Kevin Gucky in EY.
Sydney Garmon Crow.
Kevin Stoklosa, M&T Bank.
Mario Mastrantoni, Wells Fargo.
Doug Wright, Mission Federal.
Dan Palamanki, Citigroup.
Tim Zimmerman, Standard Bank.
Mark Northen, KPMG.
Russ Golden, FASB.
Sarah J. Federal Reserve.
Jeff Gear, Office of the Comptroller of the Currency.
Bob Storch, Federal Deposit Insurance Corporation.
Susan Hannigan, Jean Doc Credit Union.
John Howard, Deloitte.
Diane Bellis, Allstate.
Shiha Hu, TD Bank.
Graham Dyer, Grant Thornton.
Christine Bottleson, FASB.
Chip Curry, PwC.
Marcia Hunt, FASB.
Trent Lafrano, FASB staff.
Jay Shah, FASB staff.
Damon Romano, FASB staff.
And I think we have 2 people by audio. Marie, are you on the phone? Dev? Okay, we'll see if they check in a little bit. All right, let's go ahead and get started. We have a pretty full agenda, but I want to start this off by just giving you a little bit of an update of what's going on here at the FASB. There have been 3 major work streams since the standard was issued 2 years ago, and our last Transition Resource Group meeting was about a year ago. Those 3 work streams are education, monitoring, and implementation, very similar to virtually every project we work on. In terms of education, as you well know, right after the standard was issued, we got out on the road, Shane, myself, and other members of the staff, talking about what the standard says and what it doesn't say. And we think those presentations and sessions have been pretty effective in getting to the preparers, the practitioners, and the examiners. And we heard loud and clear from the banks, particularly the community banks, you need to get out and talk to the examiners. And our friends at the regulators have been excellent in helping set up those presentations and discussions. So I think those have been very effective. The one group that really showed no interest in the standard were the investors. And that has started to change, though, in the last couple months. With the first quarter conference calls out of the way, investors started to turn their vision toward 2020 estimates. And as a result, the phones started ringing here, both the sell side and the buy side. So we've been on the road a good bit talking to them about, what the standard says, when is it effective, what does it require, how do you do all this? The one area we had not talked to them about is how much. That is a question that they're always asking at these presentations. How much is this going to cause the reserves to go up? And we've been very careful to say, here are some things to consider that will affect it, the mix of loans, how you've applied the standards in the past, but we're not answering that question. We're really leaving that up to answer those questions. So don't be surprised if they tap your shoulder and say, could you give us an idea? One thing we have emphasized with them, there are no benchmarks, and that's something we've consistently articulated to them, and we just are going to continue that message. In terms of monitoring, there have been some areas that are obviously intersect with credit losses standard. It's stress testing, regulatory capital. We get a lot of questions about that, but we just say the regulators are responsible for those areas. We're just staying informed. In terms of IFRS 9, we did watch closely the implementation. Shane and I have been to several meetings where that has been discussed. We're looking for things that could inform us as to areas that we need to be particularly careful of or be watchful of. Compliments to those who did transition notes. We found those to be incredibly helpful in understanding the transition from one standard to another, but we also saw pretty inconsistent application or adherence to providing transition notes, and investors really gave some negative feedback in that area. In terms of industry groups, we've been meeting a good bit with the industry groups, mostly listening, but there were several things that we're taking away from those. One is there is timely progress being made by many institutions. The data quality is definitely improving. Better systems, processes, internal controls are being implemented. But one interesting note there is that changes were needed. And several of the banks have said, we needed to make the changes, but what CECL and IFRS 9 did, and also along with stress testing, is really accelerated that change. Internal auditors and external auditors have been brought in along the way, and we think that's a good addition. Regulatory examiners are monitoring the progress, starting to ask more questions. And then finally, what we're hearing is many banks are targeting a full 2019 parallel run, but in order to achieve that, they need answers to some questions, and that's really what we're here to do today. And I think that's very important, that the quicker we can give them answers today and just in general, the more they're able to wrap up any modeling they're doing, validate those models, and then get ready for a 2019 parallel run. So to not waste any more time on implementation issues, I'm going to turn it over to Shane, and we can start addressing some of those.
Great. Thanks, Hal. Good morning, everyone, and welcome to all those in attendance here in Norwalk and to those watching around the world live on YouTube. All right. I recognize that might be a bit of an exaggeration, but I've always wanted to say that. And I didn't think I'd ever get another opportunity. So before we get started, let's cover a couple of administrative items. First to note, those that are watching, if you are around the world, we have all of the memos posted online on our implementation page. So if you haven't downloaded those yet, I encourage you to go to the implementation page and download them, because we'll be referring to those memos throughout the course of the conversation, and inevitably we'll probably point to a specific paragraph within the memo. And so if you've downloaded it, it'll help you follow along with the conversation. Secondly, I know that all of you here around the table are probably familiar, but I'll go ahead and go over it again. If you do want to ask a question, please take your name placard and kind of stand it up like this, and I will try to keep track of the order of who has stood their placard up. If you do have an important point to make that's exactly on point with someone who is currently speaking, if you could just give me a high sign of, this, go like this, and I'll call on you, you can make your point. However, I will say if you take advantage of that, we will change the rules midstream, so you can't do that. This meeting will be archived and available for those that don't have 6 or 8 hours of their day to carve out and watch us all day, although I can't imagine why you wouldn't want to be anywhere but right here, right now. But we will have that available online, so you can go back and view it at your leisure, or watch it over and over and over again, which I hope you will do. Also, meeting minutes will be drafted to memorialize this meeting. Those meeting minutes, much like the last TRG meeting, will be posted with the materials online to the implementation page to supplement those materials. So before we get started on the main issues today, I did want to cover a couple of items that we have included in a cover memo with today's materials. First, we've highlighted in the memo the outreach the staff performed in the lead up to the meeting today. As you can see, we tried to capture a broad range of stakeholders as part of our outreach conducted. That outreach included discussions with auditors, financial institutions ranging from over $1 trillion in assets to smaller institutions, and also non-financial institutions. And on behalf of the team, I would like to thank all those that participate in our efforts, not only those that are here as part of the TRG, but outside of this group. Your contributions are a valuable part of our process. Second, for those in the group that submitted the TRG issues, I suspect you're wondering why there are only 5 issues being discussed today when 7 issues were submitted. In examining the issues submitted from today's discussion, it was of the staff's opinion, and the board agreed, that it didn't appear as if there was disagreement amongst stakeholders about what the issues were or the potential solutions available. Rather, there appeared to be a request for clarification in the case of private company transition and further transition relief in the case of the fair value option, both requiring the board's attention and action. We have provided a short write-up in the cover memo on each of these, so I won't dive deeply into those issues. However, we understand the issues and we plan to address them in the near term. The staff plans to bring back these issues to the board for deliberation. That will likely happen in July, for those of you who are wondering. Additionally, the FASB has received agenda requests for each of these issues separate and apart from the TRG process. Finally, the staff included 3 technical inquiries in the cover memo that we wanted to share publicly as they could have broader applicability. Those inquiries included 1, whether the scope of the exception for loans and receivables between entities under common control applies to all reporting levels, that is, parent to subsidiary, subsidiary to parent, subsidiary to subsidiary. Second, whether expected gains on the disposition of assets should be considered in the calculation of the allowance for portfolios of net investments and leases. And third, whether operating leases are within the scope of Topic 326. Again, I won't cover each of these in detail given our time constraints. However, for the last technical inquiry, that is the applicability of Topic 326 to operating leases, while the staff has concluded that Topic 326 is not applicable to operating leases because of the specific guidance provided in paragraph 842-30-25-13 and the board's original intent to not change lessor accounting, we are aware that there is a diversity of opinion as to whether operating leases should be within Topic 326 because operating leases appear to meet the definition of financing receivables. For this reason, we are considering an amendment to the guidance that would result in operating leases being included in Topic 326 and would like to get the TRG members' thoughts on those considerations. So with that, I'll pause to get members' thoughts on the potential amendments and see if there are any other questions on the issues in the cover memo. Mark?
Maybe just clarification. So you were asking us specifically about potential new direction for billed operating lease receivables?
That's correct.
Is that right? To put them into 32620?
That's correct.
And so then the leasing guidance that would say that uncollectible amounts are, I can't remember it exactly, but are basically an adjustment of lease income, that would go away.
That would change. That's right.
And what would be, maybe could you tell us anything more about the thought process behind that? I mean, I think we did like the model where it seemed more straightforward for lessors if that continued to be an adjustment to lease income. So
yep.
I was a little bit interested in the context for those comments.
I think that it was just our reaction to mixed feedback that we received when we provided an answer on the technical inquiry that operating leases were out of scope of Topic 326. And I think it really just came down to sort of what I'll call a logic test of, geez, these are receivables. They seem to meet the definition of a financing receivable. Why do we have a different treatment specifically for operating leases than one would have, say, for a normal financing receivable? And so, obviously we pointed to that paragraph that you referenced, that I referenced in the tee-up. We went back to the board's discussion and the comments around the time that leasing was released and understood that the board didn't want to significantly change lessor accounting. And that's why we answered the technical inquiry in the way that we did. However, we realized that we take those points on board that operating leases do meet the definition of financing receivable. And so we're just trying to get feedback on if people think that makes sense, we can make the change. Yep.
John?
Is it on the table at all to clarify that they're out of the scope of 326? I think we're happy with the fact that lease accounting seems to have a model and like that model, but do agree it's not clear that they don't meet the definition of a financing receivable. So it sounds like you were asking, would we have thoughts on scoping it direct, making it clear it's in 326? Can we make it clear that they're out of 326?
Absolutely, we can make that. We can make that clarification.
We'd be supportive of that.
Okay. Bob?
Just briefly on the private company transition, I think from the banking agency's perspective, particularly for the small, very less sophisticated, non-public business entities, there's been a lot of confusion about how the application works when it's effective for fiscal years beginning after 12/15/2020, but with quarterly reporting, these institutions wouldn't actually report till year end, but the adjustment as of the effective date is as of the beginning of 2021. So they effectively have to do 2 allowance estimates during that first year. And I think it'd be beneficial if they only had to wait until year end, not effectively changing the first reporting date that they would have to report under the CECL methodology.
Mm-hmm. Yeah, we've recognized that while our intention was clearly to give private companies an additional year, the feedback we received, to your point, has been, while I'm not required to apply, and let's say for a calendar year in company 12/31, if I have to make my adjustment as of 1/1, that adjustment at 1/1 would be different than the adjustment at 12/31. For the simple fact that loans pay off, loans roll on, I could sell, I could purchase, so on, so on. And so if you intended to give us another year, could you please clarify that, in fact, it is 12/31, that's when the measurement date is, as opposed to 1/1. Otherwise, the year that you intended to give us, you didn't really give us. And so we absolutely understand what the issue is, and we will clarify that, because I don't want to speak for the board, but I don't think the board ever intended to say you get a year. Just kidding. Jeff?
Yeah, can I just follow up just to make sure it's clear? The way that we understand the standard today is that the banks, for the first 3 quarters in their call reports of that year, would file under the incurred loss model, and then the 4th quarter they would have to do the entire annual CECL amount in the 4th quarter. So it actually, in my view, it's more complicated than for the non-PBs and the PBEs, which I know was not your intent. So again, just want to emphasize we would very enthusiastically support relief in that area.
Yep. Thanks, Jeff.
Dan?
Just wanted to say that the clarification that you've made relative to loans and receivables between entities under common control, I mean, that's the way we read the standard as well, but I think that's helpful to clarify, and certainly very supportive of that conclusion when we think about all the statutory reporting we do in intercompany lending that's out there, and there's a lot of full transparent disclosure in the statutory reports relative to that activity, and really don't see value in trying to go through a CECL reserve estimation process. So very supportive of that conclusion.
Kevin?
Yeah, just going back to the billed operating lease receivables, I mean, we also would support just clarifying that they're outside the scope of 326, and because I guess the 842 model, it's easy enough, and so we'd be supportive of just making it clear it's out of the scope.
Okay.
I wanted to add in on the staff's answer on gains and losses on disposition of residual assets. Just we really do appreciate getting that feedback back from the staff. That's a question that we were really struggling with, as to what was the right answer there. So definitely appreciate the staff's feedback on that. And then on the billed operating lease receivables, I did want to just make the point, since the staff appears to be considering different alternatives, there is a lot of symmetry to the accrued interest discussion that we're going to have in terms of, whether interest income should be pristine. You sort of get the same question for whether lease income should be pristine, and you get into the same question about whether reversals should be allowed to that line item. So I just wanted to maybe call that to your attention, that it would seem odd to go one direction for accrued interest and a different for billed operating lease receivables.
Okay. Graham?
I kind of just want to be the first person to use the high sign. But actually, as Mark was saying, I think we thought similarly about, or I thought similarly about the income issue. This seemed to have a lot of parallels to interest income. One other thing, although I do understand the board not maybe seeing from a receivable perspective a conceptual difference between that type of receivable and other types of receivables that would be in. So I think if you're going to clarify that it's out of the scope of 326, that might be a path forward to doing that. Another thing is if you decide that they're going to be in scope, I think you need to think about the transition guidance because 842 is effective before 326. So just something to consider when you're doing that.
Okay. All right. Those are all helpful comments. I think I could summarize it by saying either path we go down, whether we include it in 326 or not, whatever the clarification is, it's equally as important to either, if you're going to put it in, but if you're going to keep them out, then clarifying the standard that they are out. Okay.
And on that issue as well, we would also plan to have a dialogue with the board at the same time that we're talking about the other two issues.
Okay. All right. Thanks, everyone. So let's go ahead and get into the meat of our discussion and turn to Memo 8, which addresses the submission on capitalized interest. So for this submission, the staff noted that the issue submitted on capitalized interest overlaps with broader issues stakeholders have raised about how to estimate expected credit losses using a method other than a discounted cash flow method, or what I refer to as a non-DCF method, particularly for loans at a premium or discount. Therefore, to begin, we'd like to briefly discuss some of the points in the memo with respect to the discussion on premiums and discounts. When performing the research and outreach for this issue, it was brought to our attention that some stakeholders interpret the phrase, quote, when an entity expects to accrete a discount into interest income, the discount should not offset the entity's expectation of credit losses, close quote, in paragraph 326-20-30-5, and provided in paragraph 7 of the memo to mean that preparers must estimate the timing of the loss when using a non-DCF. Therefore, entities applying a non-DCF method would be precluded from applying the expected credit loss guidance in a manner that results in an allowance that increases or decreases over time. This in turn may influence how one might think about how to apply CECL to a loan with capitalized interest. The staff does not believe that this interpretation of the guidance is appropriate nor the intention of the board. However, the staff would like to provide a few clarifying points on the memo. First, the memo is premised on the fact that when calculating the allowance for credit losses using a DCF method, all components of the amortized cost basis are inherently considered because the allowance reflects the difference between the amortized cost basis and the present value of expected cash flows. However, the board decided that using a DCF method was not required and allowed entities to calculate expected credit losses using other methods. In doing so, the board acknowledged that the allowance calculation using non-DCF methods may include what the staff would refer to as theoretical or mathematical anomalies. Said differently, the board acknowledged that a non-DCF method may produce a different allowance for credit losses than a DCF approach, all things being equal, and that is acceptable. However, the end goal of the estimation process is the same, which is to produce a reasonable and supportable estimate of the expected credit losses on an entity's financial assets over the contractual term of those assets. Second, under any non-DCF method, the starting point for calculating the allowance is the balance sheet amount of amortized cost basis of the financial asset. That is, the allowance should represent expected losses on the current balance sheet amount at the reporting date. The staff acknowledges there are multiple ways to arrive at this outcome, and the staff illustrated one way in the example of applying a loss rate to the current amortized cost basis, as we believe that to be the most straightforward way to meet the requirement of the standard. The staff was not trying to eliminate non-DCF methods through our examples. On the contrary, we intended to clarify the flexibility provided in the standard. Third, the phrase, when an entity expects to accrete a discount into interest income, the discount should not offset the entity's expectation of credit losses, was not intended to force entities to project the amortized cost basis when applying a non-DCF method. However, an entity may project amortized cost basis when calculating the loss rate as part of a non-DCF method if they so choose. Fourth, the allowance for credit losses may increase or decrease with the passage of time as the amortized cost basis of the financial asset increases or decreases. While there are acceptable methods of calculating losses on the current amortized cost basis that result in a theoretically flat allowance, these methods are not required but are also acceptable. Fifth, the staff believes that unearned interest and discounts and premiums are fundamentally different. Finally, the staff included an example in the appendix to memo number 8 on capitalized interest that shows 2 of the many possible ways of applying loss rate methods to a zero coupon bond and to a student loan with a deferment period. The purpose of the illustration is to show the differences between a zero coupon bond at a discount and a loan with expected future capitalized interest, and to illustrate that a discount and future accrued interest are not analogous because of the differing par amounts over the lives of the instruments. The staff stresses that the examples are not the only way to perform loss rate calculations, and that the goal of the CECL standard was to allow multiple estimation and calculation methodologies. With that, I'll pause and ask if there are any questions on the premiums and discount piece of the memo as it has direct bearing on the capitalized interest discussion. Mark?
Thanks, Shane. I appreciate the comments that you made and some of the clarifications, which I think are very helpful. You know, a couple of things that I would agree with. I'm going to lay out a couple of things I disagree with. So I want to start with some things that I agree with here that have come out, I think, either in your comments or in some of our conversations just in the week leading up to the meeting. I mean, one is it has become, you know, even more clear to people that the guidance on premiums and discounts is not well understood, and it's not easy to follow. There was actually a question at the end of the last non-public TRG meeting about what do we think, you know, is there anything else TRG members think should be clarified in the standard? And I put up my hand and I said, I think you got to clarify premiums and discounts, because I think there's been a lot of board conversation and not a lot of it has gotten down in, you know, on paper. And so to some extent, it's not surprising to me that we're in this, you know, that we're having some confusion. I would also agree that there's inconsistencies in the guidance. I think you've pointed out some in the paper. I think I could point out others that are, you know, leading to this confusion. And I also appreciate the staff's, you know, approach with this issue, that you really do need to agree on a principle for non-DCF methods before you can get into a discussion of capitalized interest. So I think that's the right sequencing. And maybe you didn't bring up this point necessarily in the paper, but the current guidance, either as proposed by the staff or as we had previously interpreted it, is not overly practical. And I think that what we're hearing in the field is that there's going to be a lot of people that are going to have to do kind of materiality assessments and say, you know, sort of make a determination and a calculation about whether their, you know, whether their approach could produce a significant difference from what's contemplated in the literature. But I still think there's an opportunity to further clarify this guidance and somewhat take a clean sheet of paper approach and come up with something that is a little bit more theoretical and a little bit more easy for people to apply. And so, you know, I would love to walk away with a more clear understanding of the objective of a non-DCF approach and maybe an answer that could be made more practical, even if that requires an amendment of the standard. But before the TRG meeting materials, the method that was outlined, we would have said was not acceptable, because that was inconsistent with our previous understanding from previous TRG meetings, from our read of the standard. We would have said it's not acceptable. And so I appreciate you saying that the flat allowance approach, which I think we've said is what is required under the standard, is at least now acceptable. But I still feel like we have a little bit of confusion left around what are the range of things that are acceptable or not acceptable. And I think we're going to be completely fine, in a paradigm that says there can be different methods and methodologies and a wide range of those, and we certainly don't want to limit them. But it does seem like there's got to be one objective, and we have previously viewed that objective as, when it comes to premiums and discounts, that you are projecting your lifetime loss rates or your lifetime loss amounts. And, like I said, I think that has been based on previous TRG meetings and as well as our read of the standards, especially BC 60. But I think just with all this discussion we've had the week leading up to the meeting, this opportunity here in the room, I think there is an opportunity to say, would a clean sheet approach clarification just be a better alternative? So,
Gia?
I'm not going to be as elegant as Mark, but maybe just I don't disagree. At the end of the day, like we reached like BB is kind of the right view for the capitalized interest, but I still probably couldn't understand the difference between that and a zero coupon bond. Whether it's capitalized interest or the discount in this case are compensating investors for return. So I don't see a difference between the two. And if we want to get to an answer, I want to get to a consistent answer because the economic return is no different to me, at least personally.
Doug?
I agree with Mark. I think there is still a lot of confusion around the premium and discount accounting. So I think additional clarification and examples around how you handle the allowance for premiums and discounts would be helpful. I'm not sure if you need a clean sheet approach or not, but I do think there's opportunities within the industry to certainly clarify how you manage the allowance for premiums and discounts. On the capitalized interest specifically, though, I guess prior to the issue being raised, I don't think I would have ever assumed capitalized interest would have been included as part of the allowance per se, because I think I agree with the staff's approach that capitalized interest is not an asset yet at this point in time. It's an unearned, it hasn't been accrued, it hasn't been earned at this point in time. So, and when you start thinking about capitalized interest, I think you go down the slippery slope of, well, it's really easy to think about that in the scope of a 4-year deferred student loan or a zero coupon bond, quote unquote. And I think there's, reason to clarify what is the difference between those. But then you go down to the slope. Does that mean then if you require annual interest payments, do you have to include capitalized interest on an annual interest payment? And then at what point does that become material or immaterial? And do you have to do this deep analysis to say that, well, monthly interest, that's not material, but quarterly interest or annual interest or 4-year deferred interest is material. So I think it becomes very operationally challenging to think about that capitalized interest issue. And so from that perspective, I would say that we agree, with staff's approach that capitalized interest is not something that should be considered, and you shouldn't build an allowance based on capitalized interest.
Damon has a tee up for capitalized interest. Maybe we should tee that up. John, are your comments premiums and discount related or more capitalized interest? Because
Well, I was probably just going to echo what Shihao said. I don't see a difference between the zero coupon and these. I'm not bothered with the outcome on capitalized interest. I just don't like two different numbers in the appendix. I think they're the same. I like where you got on the capitalized interest. I would like the same answer on zero coupons, but if that's better for the next discussion.
Okay. Why don't you go ahead and tee that up then, Damon?
Okay. The submission on capitalized interest specifically asks how entities should consider interest amounts that will be earned when estimating expected credit losses using a method other than a DCF method. The submission provided a brief example in which an entity accrues a significant amount of interest on a loan over 4 years and then capitalizes it to the loan's balance. The submission provided 3 views regarding the estimation of expected credit losses on this loan. Proponents of View A stated that future interest amounts that are expected to be capitalized should be considered in the estimate of expected credit losses using a non-DCF method. They stated that the future capitalizable interest is like a discount and should be treated as such. Proponents of View B stated that the future interest amount expected to be capitalized should not be considered when estimating expected credit losses. These stakeholders stated that the basis for estimation of credit losses using a non-DCF method is the current amortized cost basis, which does not include future expected capitalized interest. Proponents of View C stated that the future expected capitalized interest should be treated like an unfunded loan commitment with a liability recognized and measured for expected credit losses on the off-balance sheet exposure. The staff disagreed with View A because it would require an entity to consider all expected interest income when calculating the allowance using a non-DCF approach, which was not the intent of the board. The staff agrees with View B, in which an entity would not consider future expected amortized cost basis and instead consider the amortized cost basis as of the reporting date when estimating expected credit losses. The staff believes the guidance is clear on this matter and recommends no further work on the issue. The question for the TRG is, does the TRG have feedback on the staff's interpretation of the issues in the memo? And now turn it over to the TRG members for discussion.
Or well, sorry.
Chip?
Oh, all right.
No, Chip, you lost.
Last question.
Probably worth talking about. So I think I agree with, there is a fair amount of confusion out there about what to do, but there might be a couple of things that there isn't confusion on. The first thing I think people generally understand is that you can't, if you have a loan that's at a discount, you can't, hide behind the discount, meaning that if the discount is greater than the amount you expect to lose, you can't have an allowance of zero. That seems to be one fence post that people seem to understand. The second fence post that people seem to understand is that notwithstanding the allowance can't be zero, it will be lower than a loan at par because you have less at risk. So that seems to be a second fence post. And I think where there's probably some confusion or clarity is are those the only fence posts, and how broadly can we play in between those two fence posts? It seems like the paper tees up like a third potential principle, which is trying to distinguish between discounts and capitalized interest, being what is the amount that's due if the person defaults right now, where I think it tries to distinguish between loans at a discount, the amount that's due if the person defaults shortly thereafter is par. It's 100. It doesn't matter how much time goes by, the amount that's due is par. In contrast, I think the paper points out that maybe interest is different because the amount that's legally due does change over time. And so perhaps that's the third kind of fence post that these papers raise. But are those the right concepts, like the right post, and then we should play in the middle of that? That was my question. And probably my last question, since
So I would say that what you've laid out as the three kind of principles that we were going for is that's exactly what we were going for, is that accrued interest is different because of what you pointed out. What do I owe at that point in time, and in the other two principles that you laid out. And it was also to clarify that sentence about talking about the entity hiding behind the discount, right? What was the fact that it's exactly what you said, that I can't wait until I fully accreted the discount to then say, okay, now I'll book a loss now that I've got my discount fully accreted. But rather, the allowance can increase and decrease over time, and you're still meeting the requirements of the standard. So that's how I would answer that. Graham.
Thanks, Shane. So first of all, I agreed with the staff's analysis. I think view B's the right view. That being said, when we came to that view, we understood how other people would reach the flat allowance answer. And so I think two things would be really helpful. The first is, I think it would be helpful. So Chip's notion of hiding behind the discount, I think, is important. So it might be helpful to articulate why one wouldn't do that. Because I think a simple read could say, well, look, I've got an amortized cost basis of 60. I expect to collect $60 in cash. Some of that might be related to future unearned interest, but at $60 in cash, why can't I have an allowance of 0? I don't think you should have an allowance of 0 in that case, because I think the notion of expected loss is kind of a statistical notion, right? It's not best estimate. It's what's my risk of loss times the loss that would happen if I did have a loss. I think that's the notion. It would be helpful to kind of articulate that in some way. I think the other thing is there does seem to be a conflict in the guidance between the idea that you should rarely have an allowance of 0 and sort of this offending sentence of that the allowance should be the difference between the amortized cost, the amount that you expect to collect, and you shouldn't hide behind the discount. I think those two things don't read intuitively. So the thing I would suggest is I do think there is something for the staff to do. Maybe that's in the memo following this meeting to better clarify. But I do think there is a great amount of confusion. So the one thing I would really strongly suggest is that doing nothing probably isn't the right answer.
Jeff?
So I think I may be a lone wolf on this issue, but I'm going to express this view anyway. So at OCC, we had a mixed view among my team, and I followed in view C, that I viewed it as an unfunded commitment, and I didn't really. I think it was just in limited circumstances. So I'm not looking at accrued interest in most circumstances. I think it's a limited circumstance where at origination of the loan, it is intended that I'm going to go very long time without collecting interest, and I'm going to start capitalizing that interest and charging interest on interest. So I think those would be rare situations. But in that situation, I didn't really come at it from the discount approach. That's not how I was thinking about it. The way that I was thinking about it was I've effectively committed to loan you the interest over the remaining life. And so it seemed to me like when there's no performance required by the borrower during that time period, there'd be very little chance that you would not be exposed to $100 worth of credit risk from the get-go. And so earlier recognition seemed like a better answer to me. And the other thing was, I think I could get to the same answer if I just structured it. I could get to my commitment answer if I structured it differently, right? So if I just said, hey, I only need $60, but I can't really afford to pay the interest until 4 years. So let's structure it as a $100 line of credit. I'm going to borrow $60 on day one, and each time interest is due, I'm going to draw that and then pay the bank so that I will owe $100 at the end of 4 years. It seemed like if I structured it that way, which would be very economically similar to the way this one was structured, nobody would be arguing that there wasn't a $40 commitment at the balance sheet date.
Jeff? What you laid out makes a lot of sense, but what do you require for a call report? Yeah, I'm going to write this day down for you. What do you require for call reports if you structure it the first way versus the second way? Does either of those get picked up in call reports today? In terms of unfunded commitments?
I mean, the second one clearly I think would be an unfunded commitment. I don't know that we've seen much in the way that I haven't really thought about the first kind of loan until I read this paper, because I don't know that we see a lot of that. I guess student loans is what came to mind as maybe a type of loan where you would defer for a long period of time of being charged interest on interest, but I don't think that there's a material amount of that in the banking system and private. I think it's at this point, so I'm not sure. Bob mentioned we don't say anything about student loans in the call report, so.
Yeah, I think from our perspective, view B is the correct answer here. So totally support that view. Don't think view A or C fit the situation, and so from that perspective, I think that's the right way to go. On the premiums and discounts side, no questions, a lot of confusion there when the standard first came out. There seems to be getting a little bit more understanding of it as we're going along. I think maybe an example would help as to how you should think about premiums and discounts within the non-DCF approach. I think that would be very helpful. I'm not sure you need to reconcile the two. I think if you provide the clarity around the premiums and discounts with an example so people understand it. You have your answer for the capitalized interest. And I think that's, in my view, I think that would be enough.
Bob?
Thank you. I have sympathy for Jeff's argument, but I think from my standpoint, the points that Doug had made earlier about the operationality, where you draw the line and so forth, seems to overcome the view C type of approach. I think where our examiners look at these loans, if there is a lot of capitalized interest, typically it's part of a line of credit, construction loans and so forth. I think student loans probably is the one where you don't see that built into some sort of line of credit. But if there was an institution that really structured a loan unusually for some reason, if that raised safety and soundness concerns, certainly that'd be the way the examiners would approach it. If it wasn't reflected as an unused commitment under PUC, and also if there's a lot of risk in those types of loans, more than a normal level, the examiners would approach that from a capital adequacy standpoint. So there's ways, even if view B, which I agree with, is the answer, the exposure you have over an extended period of time can be addressed, at least for supervised institutions, through other means.
Diane?
Thank you. I just wanted to reiterate some of the comments that have already been made. First, that we are supportive of UB. Also, similar to what Doug said and Shihao, I don't really view the capitalized interest to be any different than a discounted bond, a PIK, or regular accrued interest that's being paid on a periodic basis, and Doug had mentioned that. The difference is obviously that there's a deferment period with capitalized interest versus regular ongoing accrued interest. So we view them all to be very similar in nature and don't expect a different answer. But as Kevin had mentioned, I think that the literature as it's currently written is very confusing for discounts and premiums. And I think it would be important and helpful if there was an example, but perhaps the guidance continues to be written in the way that it is, which is that your goal is to calculate what you believe is the credit allowance over the contractual term of the investment, and that very different alternatives are available, and that it's written more in a principles-based perspective. But again, I do think the discounts and premiums are right now a little confusing to read in conjunction with the basis for conclusions.
I agree with view B, and I think the staff did actually a very good job of delving into this and explaining it. And I agree with Kevin that, probably a little bit of an additional example might help on that. But to me, once you start getting away from, we're supposed to be doing this on the balance sheet date, and once you start getting away from that and start projecting out into the future for one thing, then you're on a slippery slope, and so where do you stop? And in practice, most of these loans that we do are short-term loans. We're not talking about 10 years of interest only. They're short. The example that was given on construction loans and things like that, they're over a short period of time. So you're able to look and see what the answer is probably going to be. So I think it's not, you're talking about extreme examples that are occurring. And the example that was given, like you have a balance of 60 and you have a discount of 60. Well, that's economically, you get the assets for zero. I don't think we should be looking at what's the extreme answer. We should be looking at what's the common sense answer. What are most case is going to be covered by this. And anytime you get an unusual situation like that, you're going to have to look at it differently anyway, because there's going to be other facts associated with that case, and you'll be able to come to the correct answer. So, but I think we're pretty good where we are, and with a little bit more clarification should be able to get us to where it's a usable type of an answer.
Yeah.
I also agree with you, B, for many of the reasons the folks have highlighted. And I think, Shane, some of your opening comments on premiums and discounts, I think would certainly be helpful to capture those somewhere. And I don't know if that's in the minutes or, if we do that more formally. But I found as you were going through and highlighting, certain principles, concepts, if you will, that I was supportive, just as you went through those, supportive of each of those that you were highlighting. But I agree, it would be very helpful to capture those. When I specifically, I guess, when I was looking at the examples in the appendix, am I right to interpret under scenario 2, I guess we're saying for this zero coupon bond, it's okay to reach two different conclusions here on the quantity of allowance that we need. Under option A, we end up with the 6,000 allowance. Option B, 10,000 allowance. And kind of reading between the lines on option B, I guess, as this components approach was being utilized, what was layered into that is kind of thinking, in this instance, not required to do it, but thinking about the timing of when the default would occur. And I guess given the expectations the default would occur after the discount had both been fully accrued, you can't take a benefit for that. But I guess those were some of the things that I took away, and let me know if I strayed, but reading through the example.
You want to address it?
Yeah, and I think with scenario 2, option A or B, as Shane teed up, there's different ways to look at this. And for, option B under scenario 2, if you're projecting when the loss is going to happen, and in this case it's going to happen at maturity, then I think this illustrates that the $10,000 loss is basically all on par. And so nothing is on the premium or discount, so you wouldn't have a loss on the premium or discount. I think option A, and maybe it's not clearly as clearly laid out, once you read it, but I think this is more of, you're not looking at the timing of the loss, because basically you are saying, okay, I'm looking at my loss rate and applying it to the current amortized cost, and I think I'm going to have a $6,000 allowance by looking at the loss on par, looking at the loss on the discount, as of today, basically. So I think there's, a fundamental difference between the two, but, definitely understand the question. And, I think that on option B, if the loss would be before maturity, then you would going to have a loss on par. If you're doing it separately, you're going to have a loss on par, and you're going to have some sort of loss rate against a premium or discount.
But both are acceptable approaches.
Right. Yeah. As Shane kind of laid out at the beginning, is you could project what the timing of the loss, not required, or you can just look at your loss, and both of them we think you would apply to the current amortized cost today.
And I think part of this too that maybe didn't come through in the memo and why people got confused, and will be the second part of what I'm going to say. Is that we were trying to also compare and contrast the capitalized interest and the zero coupon bond and why they're different. Because in the instance of the capitalized interest versus the zero coupon bond, the capitalized interest, amortized cost, and par are the same. And so in the capitalized interest piece, you don't have a par of 100. You're waiting to get to 100. And that's part of what we were trying to highlight. But I guess the other thing that I would say with respect to the examples, and I know that many of you have said it would be good to provide examples. I would argue that if we provide examples, I think that we're not going to possibly be able to cover all the examples that one could come up with to calculate a loss rate and to do this. And I think that half of the people in the room will be completely satisfied, and probably the other half of the people are just, they're going to say, this means if you provided examples A, B, and C, why are D, E, and F not allowed? Or are A, B, and C the only allowed ways to do this? And so I guess I just highlight that providing the examples to provide clarity to how you account for a premium and discount might actually just cause more confusion than it's worth. But, we can certainly think about that. I think Doug was next.
Just thinking about this issue, I think, and you're talking about examples that would be helpful. Let's just make the assumption that the board agrees that View B is the proper approach. I think an example taking the scenario that you've built, which is a scenario at loan origination, and then following it with a subsequent analysis or example that shows that loan is sold then, and then you have it sold at a discount. And at that point in time, when that loan is purchased, what happens with the discount and the capitalized interest and so on. I think that might be helpful in terms of clarifying what happens from there.
Jeff?
So I can see that I'm on the losing end here, but I want to make sure the minority view is fully understood. So a couple of points of things I heard folks talking about. To me, in the normal course of a loan, interest is paid usually monthly, sometimes quarterly, maybe even annually. But how this is economically different to me is the fact that I'm going to be capitalizing interest, and I'm charging interest on interest from the get-go that I'm intending to do. To me, I'm essentially agreeing, I'm committing to, at day one, at inception, loan you the interest. So that's how it's different to me economically from other types of accrued interest. Secondly, I wanted to make the point that in the example that you gave there, I feel like there's very little chance that you won't be exposed to $100 credit risk because there's no performance required from the 60 to the 100. And so you're basically, the answer there is going to be, I'm going to establish an allowance for 60 on day one, but I'm going to have to build that allowance to an allowance on 100 over the next 4 years. So I just prefer lifetime, day one, earlier credit loss recognition. And lastly, I've heard people talk about construction and then student loans, but I think on the construction loan, the difference is there is usually a commitment for that expected interest. So I think you would get a different answer on a construction loan than you would on a student loan when I don't see the difference between a stated commitment and then kind of this hidden commitment.
Jeff, I'm somewhat sympathetic to your views, and but I want to understand, if we go with View B, are we talking about a big difference in what the reserve would be? Do you have a sense of materiality, size of the issue? I get all the conceptual arguments,
yeah,
but at the end of the day, from a practical standpoint, I don't see the amounts being that large, and you all haven't, as a collective group, have not really captured this type of data in the past, which would suggest to me that it's probably not that big of a deal to start with. And then finally, if you really saw a particular entity heading down this path and structuring to take advantage of, kind of a View B, if you will, you would probably take some other action through the examination process, I would think.
Yeah, I think Bob made that point that, obviously if we're concerned that if we recognize early on that they're going to be owing 100 in 4 years and they're not going to be able to pay any of it, I think that we would try and deal with that.
But it would have to be more than just one transaction to make a
I don't know that I don't think we see this a lot. So, it is more of a theoretical debate at this point. I'm not saying that there's material, and I tried to make that point at the beginning that I think this is a very limited situation where I'm giving that answer. I wouldn't want to consider accrued interest. I think it's very limited to kind of the pattern that was presented in the paper. So I'm just trying to address where I come from it there. I'm not suggesting that I think it's a material issue in the industry, but I also worry that if we set it up this way, maybe we encourage this type of lending.
All right.
Seems unusual to me to try to reserve for interest that you haven't recognized in income yet. And it feels like you could address your concern, which I think is a sort of limited scope for your non-accrual guidance. So you would not allow them to recognize that interest, and therefore they would not have the need to reserve for it.
But how are we going to allow them to not, when there's no performance? I mean, typically that's what we look to for non-accrual, right? Is that you're not making your interest payments. And if there's no performance required for 4 years,
right? If you feel there's a credit risk there, I think the guidance would permit you as the
no,
examiner to say,
it clearly would. It would, but I just worry that with there not being any performance during that time period, might be challenging to understand whether or not they're going to be able to make that payment or not.
Jeff, the other observation I would make is that this has a very kind of 1980s feel to me. There, it was these. Well, I'm right there with you, buddy. There were a lot of transactions that were structured like this. My recollection back in the early 80s and mid and late 80s, and you all seem to have kind of tamped those down through other processes. So I didn't want to spend a lot of time talking about some conceptually that, frankly, materially just doesn't move the dial that much.
First, I want to clarify, I'm not against where the staff came out, and I'd like option A. I think that makes a lot of sense. If you think about, I lend 60 today. It's option A on how you, no, in the examples. In these scenarios. Sorry, not view A, option A. This was Chip Curry. So maybe I should knock my name tag on the floor too. Everybody knows you are. Yeah, it's unfortunate. In the example of I lend 60 and it's going to get up to 100, if I think I'm going to lose 100, I wouldn't want an allowance of 100 today when there's only 60 on my balance sheet. I conceptually totally agree with we should only be recognizing losses on what's on the balance sheet. I just don't understand the difference between the zero coupon and the capitalized interest when there are absolutely no payment obligations, no ability to default in between. So I would have thought we're under the option B way of calculating the allowance. We are figuring out the timing. So I don't understand why it's a different result. Quite frankly, I think people will want to go to option A anyways, and it's using the loss data we already have against the current balance. But it seems like we are sort of incorporating, you have to think about the timing, and that's why I don't understand the difference between a zero coupon and a capitalized interest loan when there's no ability to even default in the intervening period.
Mark. Shane, I want to go back to a comment that you made just a few minutes ago about concerns that providing an example would lead to even more confusion in this area, and I want to assure you that can't be the case. There's a lot of things that aren't clear, and but before we had, and I think the layout and the discussion, I appreciate Dan, you bring up scenario 2 and the option A and option B. So under our previous read of BC 60, there were different options available, but in order to what to use as the numerator and what to use as the denominator in a loss rate, that always got you to the same answer. And so now under this interpretation, there's this option A, which gives you a different answer. And so now there are effectively, I think, 3 choices with how we're going forward. You can do a DCF method, you can do a non-DCF method, and then you can do non-DCF A and B, I think is sort of the takeaway. And, I think my preference would be to limit it to just one kind of non-DCF approach as opposed to introducing a second. And part of that is because we just haven't figured out how to operationalize option A, like how it would work in a situation where you have not just a single loan that defaults at maturity, but if you are all of a sudden have a portfolio, which I think is going to be the case in most cases, where defaults happen, not every loan is defaulting, and the loans that do default over time, we haven't found a way to come up with a loss rate that, one, complies with the guidance, and two, we think could be operational to do option A. And so my fear is we're sort of giving the impression we're giving an alternative that may not be practical. And part of the reason for the breakdown when we try and do option A is that I think the staff's intending to do something that doesn't involve projecting a loss, but the guidance still requires that the numerator be based on the historical losses of the amortized cost basis, which does, as BC 60 points out, it does implicitly give you a starting point that is a projection of future losses of amortized cost basis. And so I think that ends up being part of the problem with option A and why it may not be operational without some amendment to the standards, because you do still have the requirement that the numerator start with a projection of write-offs, what future write-offs of premiums and discounts are going to be, because that's in the historical numbers.
I don't know that the staff is requiring. You said something to the effect of the staff is requiring. I don't think that any of the examples that the staff highlighted, which again goes back to my comment on examples, was the staff requiring that you had to use this specific example. I think that, I'll speak for the team, but obviously jump in. But I think that we recognize that when you calculate a loss rate, there are a number of ways that you can calculate a loss rate. You can calculate it on origination amounts. You can calculate it using amortized cost. You can, and even when you use amortized cost, you can go historical. You can figure out what your amortized cost is going to do currently and come up with a remaining balance. And there are a number of ways that you can calculate an amortized cost, a loss rate. And so I think all that we were trying to say is that you're not required to project out what an amortized cost would be. You're not required to do that. You can, but you're not required. And the loss needs to reflect whatever the balance sheet reporting date, whatever's on your books at the balance sheet reporting date, the loss needs to reflect the loss that's on that balance at the reporting date. And again, there are a number of ways that one could get there. The easiest way that we found is just multiplying it by the amortized cost at the balance sheet date. Now, if you want to say, I'm calculating my loss rate based on a historical amortized cost, and then I'm applying that to a new portfolio that's the same, and my amortized cost inherently calculates a timing factor that should line up to where my book is at the current balance sheet date, that's fine. I think you just need to be able to support that. But I think that that's not wildly different than anything relative to the whole loss projection itself that you need to support it. So that's what I highlight with it's hard to do examples, because the minute you put the example down, then someone thinks that that's the only way to do it, or that's the requirement, or that's the FASB's preferred way of doing it, and that's just not the case. So that's all I'll highlight. Sorry, go ahead. Wes, sorry.
Yeah, thanks very much. Times like these, I wish my plane had been further delayed. Joking aside, three points to add. I think it's a terrific discussion. I think it illustrates the value of the TRG and tackling these issues. So thank you to the staff for leaning into this discussion. I think it's an important one. Two, the next point I'd make is, for all of the reasons, Shane, that you've described in terms of variation in product, variation in information systems, variation in methods, but a consistent objective, all of those call for institutions to have good procedural discipline, the same as we've had as a requirement of our guidance, both paired with the federal banking agencies as well as the Commission's guidance for public institutions. So I wanted to take the opportunity to underscore the importance of procedural discipline and good controls around that. And then the third piece, and I won't repeat each of these points for each of these issues, but they apply to nearly every issue on this agenda. The importance of disclosure so that investors understand the approach that was taken on these issues and can begin to understand how one institution is similar in some respects and different in other respects to other peers, because no doubt there will be variations. So three points. Thanks for the dialogue, procedural discipline, and good disclosure.
Thanks, Wes. Do we have any more comments on capitalized interest? So if I can maybe try to summarize, and we certainly appreciate all the feedback. This is helpful, particularly in light of I think we knew that there was confusion about premiums and discounts, but I don't know that we knew to the degree that there was confusion on premiums and discounts. So that's helpful. I guess the way I would summarize it is, it sounds like for the most part, Jeff will leave you aside for a second. That most are comfortable with view B of where the staff landed, but it sounds like perhaps in the summarization of the discussion, it would be helpful if the staff were to articulate a little bit better why we think accrued interest is different from discounts, or why the capitalized interest is different than a normal, say, discount, and how we got to view B. Because it sounds like what I'm hearing is everyone's comfortable with view B, but maybe they don't fully appreciate how the staff got to view B, and it would be good to articulate that. For premiums and discounts, I guess what I'm hearing is that maybe some examples would work. Although, and the staff can take that away and think about how that would work. Is there any other guidance other than just a litany of examples of all the ways that one could factor in a premium and a discount that would be helpful? Is there some sort of discussion in the minutes? Maybe it's, to Chip's point, the three very distinct pillars that we were coming up with and very clearly articulating what those are. The fact that there are a number of ways to calculate loss rates, and that's okay. And then piggybacking off of what Wes said about procedures and how a company needs to document. Is there anything else that we can provide beyond what I've just described that would be helpful? Ram?
I think in particular focusing on the paragraph that says you shouldn't hide behind the discount. I'm forgetting exactly how that's articulated in guidance, but I think that would be a key sentence to focus in. What does that mean? I think that's really a big source of the confusion for discounts and premiums.
Okay, Mark?
I think just clarifying the principle of a non-DCF approach would be helpful, what the objective is versus the methods. And I would really encourage you to consider amending the standard to permit a par-based loss rate to be applied to today's amortized cost. Because I think that would accomplish some of the objectives of having a loss rate that is doesn't involve a projection. And it would also be, I think, a little bit closer to what some people will do in practice. And so it would eliminate the need to do some of these immateriality assessments. If people could apply a par-based loss rate instead of a loss rate built up based on amortized cost to the amortized cost today, at least as an alternative.
Mario?
So Mark, when you say par-based loss rate, what do you mean by that? You mean just the denominator is par or the numerator is UPB? Because the loss rates aren't UPB, they're they're based on the recorded investment, right? So you think you're going to lose principal of X, it's going to be greater if you have a premium, it's going to be lower if you have a discount. So the fact that the denominator is based on par shouldn't matter as long as your loss rate considers the discount or the premium.
Yeah, so just as an option, I mean, there are two ways of doing it. So the way we have understood the guidance today is as long as you start with amortized cost as the numerator, you can use whatever you want as the denominator as long as you have a consistent base to which it's applied. And that logic says it's because I'm trying to forecast what my full expected losses are going to be over the life, right? Which is why we had developed this view, which is not consistent with what the staff had in the paper. Another option, I think, if we wanted to say, let's have an option where people don't have to project future premiums and discounts, would be to use a loss rate that had par as the numerator and the denominator, and apply that to the amortized cost basis today. I certainly don't have as much visibility as to what financial institutions do as you do, Mario, but it seems like a lot of entities are still using par-based loss rates, and applying that to the amortized cost basis today gives you a pretty elegant answer, I think, as we've sort of thought through it. But that would be precluded today because of the guidance that says that your numerator has to be based on amortized cost. So.
Yeah, Chip.
I guess what I had taken away from the conversation at the table was perhaps that your numerator and your denominator of your loss rate don't have to be exactly consistent with the current amortized cost basis, which you might find as amortized cost basis change over time. And if in the past you're originating loans at a discount and that's how your loss rates are calculated, and now your loans aren't at a discount. So if that's okay, that you could have different bases under how the loss rates are calculated versus what they're applied to, and that's the staff's intention, I think clarifying that point, perhaps, amending some of the guidance that Mark's referencing in the basis of conclusions would be helpful.
Okay. I think that we will. Yeah. Let's move on to accrued interest. Damon, you're teeing that up. Yep.
All right. Accrued interest. Memo 9 discusses the submission on issues related to accrued interest. Through the submission, stakeholders presented 2 issues. Issue 1, the inclusion of accrued interest in the definition of amortized cost basis, and issue 2, the reversal of accrued interest on non-accrual loans. And we're going to present each issue separately. So issue 1, stakeholders question whether the inclusion of accrued interest in the definition of amortized cost basis is appropriate. Specifically, stakeholders have noted significant costs that this definition imposes on preparers to comply with measurement, presentation, and disclosure requirements of CECL. The staff believes that it was clearly the intent of the board to include accrued interest in the definition of amortized cost basis, which is supported by paragraph BC 62 in the basis for conclusions. This paragraph explains that amortized cost basis is the present value of the contractual future cash flows, both those designated as principal and those as interest. Additionally, the definition is aligned with the former measurement basis for impairment, which was recorded investment and which included accrued interest. However, the staff believe it was not the intent of the board to impose significant cost on preparers for an amount that would likely be immaterial to the balance sheet in many cases. Therefore, the staff recommends practical solutions be provided to alleviate preparers from this operational burdens while maintaining the current definition of amortized cost basis. These practical solutions include allowing entities to perform an assessment of collectability and determine the expected cash flows for accrued interest separately from other components of amortized costs if an allowance is needed at all, as noted in issue 2. Entities should also be allowed to continue presenting the accrued interest receivable outside of the loan balance with a disclosure of the amount and location of accrued interest on the balance sheet. Finally, the staff believes as a practical expedient, entities may be relieved from tracing accrued interest amounts included in amortized costs to each origination year and by class of financing receivable in the new vintage disclosure by disclosing the total amount of accrued interest and amortized costs as a footnote to the vintage table. The staff believes that these amendments can be handled as codification improvements because they are clarifying the board's intent while providing a practical means to implement the standard. Okay, so issue 2, the reversal of accrued interest on non-accrual loans. So stakeholders have asked how accrued interest should be reversed upon the associated loan being placed on non-accrual status under CECL. The submission provided 2 alternative views. So view A was to reverse the amounts accrued but not collected back through interest income. Additionally, any allowance that was recorded for accrued interest would be reversed by crediting the credit loss expense. View B said write off the accrued interest through the allowance for credit losses. This would require a full gross up of the allowance before the write-off. Proponents of View A note that regulatory call report instructions allow regulated entities to reverse accrued interest against interest income today and do not believe the board intended to change this practice as stated in paragraph BC 99 in the basis for conclusions that it did not intend to change non-accrual practices. These stakeholders are specifically concerned about an unanticipated effect on net interest margin or NIM, which would be the case if they had to change practice regarding the reversal of interest income on non-accrual loans. Proponents of View B stated that the guidance in Update 2016-13 is clear that accrued interest is part of amortized cost basis, and as such, an allowance for credit losses is required, and any write-off should be done through the allowance. The staff believes that it was not the intent of the board to change this non-accrual practice. Additionally, the staff notes that Update 2016-13 applies to regulated and non-regulated entities, both of which may be following well-understood non-accrual policies today. For that reason, the staff proposes alternative View C that provides a practical solution for all entities. So View C is basically entities that follow non-accrual policies, both regulated and non-regulated entities, may reverse accrued interest according to that policy, which may be through interest income. For entities that do not follow non-accrual policies, the reversal of accrued interest should be accomplished through a credit loss write-off as written in the CECL guidance today. Additionally, under View C, entities that follow non-accrual policies that prescribe the procedure for placing loans on non-accrual and the timely reversal of interest income upon non-accrual status should be exempt from measuring an allowance for credit losses on that accrued interest amount. The staff understands that certain financial assets may have terms and conditions that allow interest to accrue unpaid for a significant period of time without requiring that the loan be placed on non-accrual status, such as the student loan example contemplated in the capitalized interest topic. In these cases, the staff expect that a reasonable non-accrual policy would require that an allowance be established and measured for these significant amounts of accrued interest. The staff supports View C as a pragmatic solution that considers the cost burdens of adopting the CECL standard for entities that have well understood non-accrual policies today. The purpose of the optional pragmatic solution is to allow entities to follow established non-accrual policies rather than departing from those policies in order to follow CECL guidance. The staff believes that the changes to the codification can be handled through codification improvements because the amendments would clarify the board's original intent not to change non-accrual policies. So the question for the TRG is, does the TRG have feedback on staff's interpretations and recommendations in this memo? At this point, we'll turn it over to the TRG members to discuss Memo 9. John?
It's Chip.
Sorry. Chip.
Supportive of where you guys are coming out on this. I think it's a very practical solution. I think where we draw the line, and maybe it's a question on what codification improvements mean and whether there's going to be an exposure period and it's really like technical improvements. I think there's going to be some confusion on a couple of things. One, the call report instructions talk about there's a cutoff on, interest income in theory is stuff that's this year, and if it was a prior year credit loss, I know we have kind of a concept of it can't really build up for a long period of time, just unabated. So you have to have a non-accrual policy, but are we going to try to link it to call report? Or are we trying to link it to, it's got to be 90 days? Should it be 180 days? And what about entities that stop accruing but don't necessarily reverse it at the same time they stop accruing? Because when you get out of the regulated space, I think there are entities that will maybe stop accruing, but they won't necessarily reverse it at that time. And so to me, the linkage here seems to be we're okay if it's ultimately going to come out of the interest income line that it shouldn't be a credit loss. And so the timing difference between I'm not still accruing but I'm not reversing, to me, shouldn't necessarily preclude you from this, but we're going to have to be pretty crisp in how we word what a reasonable non-accrual policy is. And I guess the we meaning you. But that to me it's a little confusing in this paper because we talk about the call report instructions, but then in paragraph 10, we say companies follow GAAP and they reverse it through interest regardless of whether it was the current period or prior period. So we're already kind of delinking from the call report instructions. And then we clearly throw out the 4 years is too much. What is too much?
Just to the point on the call report instructions, I think that the paper tried to make it clear that the instructions actually say at first follow GAAP. Of course, what's GAAP? And then it says one acceptable method includes reversing prior year's interest against prior year or against the allowance. So that's not, we don't say that's the preferred method. We say it's an acceptable method. So for call report purposes, at least today, if they're reversing all the interest against current year to date income, that's acceptable. And I think if you're following the typical non-accrual rules, and I'd have a separate comment later for credit cards, but normally you're only going to have 90 days worth of interest. So only in the first quarter probably is it going to be a, year over year issue. So I think there's latitude within the existing instructions, and depending on where they come out, we can revisit the instructions anyway on this particular issue.
Just to clarify, your one point, John, about what do we mean by codification improvements and will there be an exposure? It will be like a technical improvements project. There will be public exposure. It'll go through. I mean, that's what the staff is proposing.
And,
I think. Sorry, go ahead.
Oh, and I think we do recognize that, obviously for regulated entities, there is the call report, the practices today. And when we say, in the paper, a significant amount of accrued interest or, non-regulated accrual policies being similar to a regulated, that obviously is not solved today. And during the drafting process of that, we're going to have to, think about that and have some options there, which would be out for exposure for comment, once we get to that part.
Okay, Sarah, I think you might have been next.
Thanks, Shane. I will channel my inner Joanne Wakeham today, who's actually at home with pneumonia, but after the YouTube comment, I wonder if that's why she's not here. So regarding this overall topic, on the issue number 1, I think the agencies generally agree with the proposed approach. We did have a little bit of back and forth about kind of liking the option 3 of actually taking the accrued interest out, but we did agree that the option proposed actually makes practical sense. So no significant comments there. But on the issue number 2, I think Bob started to comment a bit on the credit cards. When reading paragraph 47, which specifically says that, and I think last sentence of the first paragraph on view C, it says that because the accrued interest that will not be collected will be reversed through interest income, it should not be required for these entities to measure an allowance on accrued interest. So we were kind of curious what the FASB was envisioning on things like credit cards, where I think oftentimes banks actually don't have a specific non-accrual policy on that. There's a charge-off guidance at 180 days, but oftentimes not a non-accrual policy. On something like that, kind of reading that paragraph, it seems like you're basically saying don't have allowance against it. Is that what you guys intended when you actually wrote that paragraph? Although following a couple of paragraphs was a little bit confusing how that interacts with actually establishing the allowance. I think that was the point that we would like to kind of clarify what the FASB meant with that view.
Okay, and Bob, you have a follow-on to that?
Yeah, Sarah pointed out paragraph 47 and referenced paragraph 48, and I think paragraph 48 seems to get at where we would want to come out, where it suggests that as part of an overall non-accrual policy, you might scope out, let's say, credit cards, because they typically don't go on non-accrual and they're charged off typically in 180 days, so you'd have 180 days interest. But if that could be done sort of as an element of the overall non-accrual policy, as the second half of paragraph 48 suggests, if that's what was intended, I think at least from my own standpoint, that would work from a regulatory perspective.
Right, I agree. The interaction between the two was confusing. I was reading through, so clarification on that would be very helpful.
Yeah, and I think when we were thinking about, having no allowance on, something that would have a non-accrual policy, it was really because and maybe credit cards would fall out of this, but if you're going to have a non-accrual policy that says in 90 days, for example, on other loans that you would reverse the interest, we didn't see the point of having a provision for the allowance that's never going to be charged off, and all you're going to be doing is reversing that provision. But if you didn't have, for credit cards, for example, if you didn't have a non-accrual policy that says you would reverse the interest and interest would accumulate, I think at least our initial reading is that you would have an allowance on those amounts because you don't have that provision you would have a provision, you'd actually have a charge off on those amounts versus, reversing the interest. But I think in practice today, we definitely, do you have a follow-up on that?
Yeah, I was just going to say, I think cards are different, and correct me if I'm wrong, but the interest is capitalized into the principal balance, so it is included in the allowance, which is different than other assets where interest is accrued and then recorded separately on the balance sheet, and then also very difficult to disaggregate and say which portfolio does it apply to.
So I think that there, when we were thinking through this was, our initial thoughts was, as Damon said, if you have a non-accrual policy and you're reversing that interest, then you could apply this. But if you don't have a non-accrual policy, then you would have to follow CECL. Now, I think what's maybe a bit odd or highlighted is that for credit cards, you're capitalizing that interest, you have an allowance on that interest, but perhaps at the point of non-accrual, or at the point of write-off, there is a reversal maybe of some interest, but it's not written off. The allowance is maybe just adjusted period to period. We've heard that. So I guess I would ask those around the room with significant credit card books of what your suggestion would be to how to apply this, because it was tough for us to ring fence. You don't have a non-accrual policy, so you would apply CECL. If you have a non-accrual policy and your accrued interest is separate and apart and you reverse accrued interest, why would you book an allowance that's just going to reverse, as Damon articulated? But then if you don't have a non-accrual policy, but then you're reversing interest income, it's sort of outside of saying, well, credit cards are special. We couldn't figure out how to ring fence that. Does that make sense to,
I guess your views three to link non-accrual policy with the reversal, where to reverse it to. Does it have to be linked? Because it's a practical combination, so there's really no principle to support that. So credit card is not really an exception. It's just what we have been doing. So to Mario's point, all the accrued interest except the current month's accrued interest are in the capitalized cost, so it's part of the basis actually. So then you actually do reserve against it. So we don't not reserve 180-day worth of accrued interest. But all credit card companies, as I understand, they all purify through NII or fees when it gets charged off. So that's the current practice. It would be a pretty big change if we had to do it through allowance. So like View C originally, when I read it, was credit card in mind. To me, there is really no conceptual linkage between non-accrual policy and where it reverts to.
Okay. Sorry, go ahead, Jeff.
I just wanted to follow up on, I thought I had heard there were two ways of doing it. It was purification and then there was suppression, which I think maybe is a non-accrual. Do some banks do that, or?
I have never heard the word suppression, but I heard the word suppression, but not in the credit card context. So my understanding is most credit card companies are doing purification. Very seldom I've heard anything differently in terms of when it's charged off, always reverse through the revenue items, whether it's NII or fees.
I think Graham may have been next.
Thanks, Shane. So I think the discussion on issue number 2 has been good. I kind of echo one thing John said, which is that there are a number of non-regulated lenders that use non-accrual in one sense, and that they stop accruing interest, but they may not reverse it through interest income. So there's sort of a third. Not all non-accrual policies include reversal through interest income. So if you're thinking about how to do this, maybe linking it not to the non-recognition of interest income, but to the what do you do with the accrued interest income you don't expect to collect aspect of it. I did want to talk for just a second about issue number 1, which I think we've kind of scooted past. But I wanted to ask a question. So I agree with the staff's analysis that there's no conceptual basis for removing interest income from the definition of amortized cost. I think that's right. I wonder about the practical expedient. I very much like the disclosure practical expedient, but I think for those that don't use a non-accrual policy, that would be applying CECL to an accrued but unpaid amortized interest that they're not going to reverse, so it's part of the ACL. It seems like you'd have to apply CECL fully. And so one of the things that occurred to us is we sort of wondered how practical the expedient is. So if I've got a pool of accrued interest that I'm applying CECL to, I would presumably have to apply the pooling guidance. And I would think that when I apply the pooling guidance, I would have to look to the risk of the associated with the loan that generated the accrued interest. Because I think, GHAL's probably going to pay his accrued interest, and I'm a deadbeat, so not all accrued interest is created equally. So I do wonder about, if you're applying CECL fully, just how practical that expedient is. So actually, I sort of found myself more sympathetic with View A and only with the disclosure aspect of View B.
Diane?
So from the insurance industry's perspective, I just wanted to confirm that if we go down the path of a practical expedient, that it also would be applicable to 326-30 for AFS debt securities, because the definition of amortized cost changed for that also and includes accrued interest. And so somewhat to Graham's question, if this is relevant to AFS debt securities, we're talking about individual assets that are being assessed. And we have a model today that has amortized costs that excludes accrued interest. It's reported in other assets on our balance sheet. And then we've got a fair value of our assets that is a clean price. It does not include the accrued interest. So when you look at the difference between those two amounts, that's equivalent to unrealized gains and losses that are reported on the balance sheet. So we need to ensure that that model doesn't change. Otherwise, the whole model changes as far as where things are presented, what they represent, how all the disclosures fit together. So I just wanted to ensure that if we go down the view of the practical expedient, which we're supportive of, especially for AFS debt securities, that we also provide the practical expedient for 326-30.
Mark?
Yeah.
Oh, sorry. No, go ahead, Mark.
I just wanted to get some clarifications on some points that have already been raised that I think have raised some confusion. So if you have a regulated entity that does not have a non-accrual policy, but they do currently apply reversal, which I think would be the majority credit card practice. So their current policy is reversal, but they don't necessarily go non-accrual. They accrue right up to the point of charge-off. I think there are some credit card companies that actually do go non-accrual earlier than charge-off. But it would seem like, if you read this paper literally, that where credit card companies are consistent today and that they're reversing to income, this would force diversity, because it would say, I think if I'm reading this correctly, this is actually a question, that the entities that do have non-accrual in advance of charge-off, they would be required to reverse. But entities that did not go non-accrual prior to charge-off, they would be precluded from reversing. Is that correct, or did I get that wrong? And then I've got one other follow-up question. In other words, is your policy today reversal, or is it tied to, do you have a non-accrual policy that takes you non-accrual prior to charge-off?
The way that we were thinking about it was the latter. You have a non-accrual policy that takes you non-accrual to then you reverse, which is why we asked, how are people viewing credit cards? So if you're waiting and you don't have a non-accrual, but you're still reversing, one of the things I mentioned is that for us to ring fence that didn't make a lot of sense, other than it was just going to be what I'll call a practical expedient prime, which is the practical expedient is just how I articulated it. But if you have a credit card, then it would work this way as well. But happy to hear how that would work, Dan.
Shane, for what we do from a credit card standpoint is along the lines what you just described. So we continue to accrue interest even as it goes further and further past due. And then once it's 180 days past due, we, as Mario described, I mean, the interest continues to build into the actual loan balance itself, which is unique for all of our other loans. Accrued interest is separately presented on other assets, but for credit cards, it builds into the loan balance itself. And then at 180 days past due, we would write off the entire balance. And we do reverse the interest piece through interest revenue. But what we're also doing along the way, our loss rates are capturing those loss amounts. So we have within our allowance for loan loss on credit cards reserves related to that interest that is earned but will not be collected. Now that kind of stays there, and as the portfolio grows, it might get larger or smaller, or gets adjusted, but it's within the allowance. So we're not, from a reserving standpoint, we're not waiting until the write-off 180 days past due, in your example, to take the loss.
Right. So if I'm hearing you correctly, I think it's sort of what I'll call almost a hybrid of what we're describing. So in other words, you would accrue, and you would have a loss, and that loss rate is updated, and your allowance by definition is updated as you go along. But then once you go to write off, you just reverse the interest piece and wouldn't necessarily want to reverse through the provision, which is what we recommended is if you don't have a non-accrual policy, and you would follow CECL as written, meaning a reversal through the provision.
Right.
And so I think that what you've highlighted is unique to credit cards. And that's the difficulty that we found was, again, unless you're going to do a practical expedient prime from sort of standard setting perspective of this is how the practical expedient works, unless you're a credit card, then continue to do this. That's where we struggled a little bit with what to come to. That doesn't mean that can't be done. It just, we would have to consider that.
Is one way to do this to kind of what I think was said over here is disconnect the two. So kind of say, look, if you're providing an allowance on amounts that include accrued interest, if that's what you're doing because you're not shutting it off at a timely basis, then similar to like there's an accounting policy choice about where you put passage of time either through credit loss or interest. Mm-hmm. Could you similarly say it's an accounting policy choice of when you actually do charge things off, do you kind of purify the income statement, that's okay. So that's like one thing where you kind of, give folks a choice on where they put the geography of the reversal. But then it's a separate decision on do you actually need to have an allowance? And that's where there's like the practical expedient. So do you like I said differently, do you tie the practical expedient to just shutting off and reversing quickly? That's a practical expedient. But then completely separately, you say if you're not shutting off and reversing, but you want to reverse through accrued interest or through interest income, that's a policy decision not that different to what we do with passage of time.
And I think that there's a second element of that as well, of if you make that policy choice to reverse and you have booked an allowance, you are free to adjust that allowance over time in the case of a credit card, or you would do a partial write-off. Right. Because I think if you don't make that clear, then that's where you get into the conundrum of I'm either doing the partial write-off or I'm not.
And then you couple that with Wes's comments earlier, which is, if there's different ways people are going to work things through the income statement, then it's important to disclose that to users so that they understand what is and what is not in, sort of net interest income, and where you could have a release of an allowance and a hit to net interest income in a particular period, that's clear to that's what your result would be.
Right. Sure, Dan.
Yeah, that's exactly what it was, just the disclosure point that Wes had made earlier, that, yeah, what we're doing on cards and what the industry is doing on cards seems entirely appropriate to me. And as long as, if some of the practices there are not specifically in line with other loan portfolios, if you have transparent disclosure on that, as far as what's hitting the various lines, that would seem meaningful to me. Just when you're reversing interest, I know there's such a close focus on NIM, which you highlight in the paper, and there's every quarter a walk that's done on prior year's quarter, or in basis points net interest margin, and what is driving a Fed rate change versus, it's all broken down, and so it's analyzed so closely by the analyst community, the Treasury folks, a lot of folks, and so much importance placed on that metric to keep it the way it's been done historically.
Oh, Bob.
Just getting back to what the call report instructions do cover, the 90-day rule I think was mentioned before for non-accrual is not required to be followed for consumer loans, which include retail credit cards, which is why perhaps we have the dilemma. Maybe we created ourselves decades ago. But we do go on and say such loans should be subject to other alternative methods of evaluation to assure that the bank's net income is not materially overstated. So I guess that's kind of getting at unit of account, non-accrual individual loans, but we want income collectively, so to speak, to not overstate the amount of income, say, on credit cards. Mm-hmm. And again, going back a number of years, and maybe the industry's all migrated to one practice, which is why I was interested to hear the comments. We did, at the time, based on the practices, say, 15 years ago, I'm guessing, have separate items, depending on what your practices were, for separate valuation allowances for uncollectible retail credit card fees and finance charges, or the amount of the ALLL attributable to retail credit card fees and finance charges. So we recognized at the time, from what industry input was, there were differing practices. Now maybe to your point, that's all migrated to one or the other, but yeah. So maybe we can get rid of one of those items going forward. But there in the past, there have been two different practices, which perhaps now is one. I think the agencies would prefer to have consistent practices across the industry.
Sarah. Sorry, these cameras in the way. I can't.
I gotta do this. Just a clarification question. So I know Shihao now is saying that the industry has converged to one method. Is that true? Because I was trying to kind of sift through 10Ks to understand if there's consistency, and I actually thought I read there is inconsistency in the way it's reversed. Some banks seem to be not doing the purification method of actually reversing through interest income. Am I just kind of reading through that wrong, or is there still some diversity in practice? And I do ask that question too, because I mean, consistency and the way that's actually being applied would be really helpful for us to understand. And just kind of reading through the disclosures, and maybe this goes back to Wes's point, it wasn't as clear to me when I was reading through if that's consistently done.
Yeah, Sarah, maybe just to respond, I don't think I can claim everybody conform into one methodology. At least when we're doing bids on credit card portfolio, that's what we were told by the bankers, that everyone is doing the same thing, at least from a reversal perspective related to charge of interest. So that's how I got my impression, but I have no way to verify that.
And maybe related question too, is the reversal, like all of the 180 days of interest is being reversed to interest income, or just the current year's portion? Is there kind of diversity in practice that as well? Or consistency in practice?
It's all of it for us. Yeah, it's all of it for us as well.
Fred, I'm going to put you on the spot for a second. Fred Cannon, analyst. I'm hearing all this diversity, and I'm listening to Dan's comment, how closely it's watched. What are you guys doing? Is this concerning conversation to you?
So a couple comments. Number one, I would say that, the comment earlier that people analyze NIM, every which way and kind of want it to be consistent with the history. I don't really believe that is the case. I think that, in fact, one of the benefits most the analyst community believes is that CECL moves us into the direction of being able to separate our understanding of credit loss from net interest income. Now, there's a full recognition, I think, by all investors that we can never separate the two completely. There's no such thing as a pristine NIM versus a pristine credit cost. So there are always going to be some mix. But to the extent that we can move in that direction, it would be positive. I think the second comment I would just generally have is that one reason that high credit cost businesses, whether it's cards or the other non-bank finance companies, the reason they trade at PE discounts is because of the volatility they see in their earnings from credit that goes not just through an identifiable credit cost, but also through the net interest income. And so, at the end of the day, net interest income and credit are tied at the hip. We're just trying to be able to, through this, better understand the differences. So I don't think my own belief is just because something is currently practiced doesn't mean it's well understood by the community of analysts. That would be my only point. Number one. Number two is a lot of these issues that came up during the financial crisis, such as the construction loans and the capitalized interest that goes into construction loans, and the fact that was not at all well understood by investors at the time when construction loans were first going bad significantly. And I would even argue that it's probably already forgotten by a significant share of investors. So I'm not kind of naive enough to believe that we're going to kind of move towards a pristine NIM or a pristine credit cost. But I think in all these discussions, the extent that we can move in that direction and not be held up by current practices, I think that would be a positive.
Thanks.
Chip. The only point I was going to make is I don't know that it was intentional in the tee up. Talked a lot about well-established long-running policies. I would have to imagine that when adopting this standard, people are going to fundamentally rethink a lot of different things, and I think we wouldn't want to limit this non-accrual thing to if you've had a pre-existing accounting policy, just if this is what your policy is, this is the answer with disclosures. I think that would be important as well, because I could absolutely see people wanting to rethink the way they do their non-accrual or other policies in conjunction with it adopting a standard of this magnitude.
A couple of things that I think we'll struggle with, maybe one smaller point and then one larger one. I think there will be instances where it will be challenging to say is something a non-accrual policy. And somebody brought up suppression. I have actually been walked through a little bit suppression policies where you're maybe using portfolio level assumptions to prevent a certain amount of interest from being accrued because you ultimately think it will become not collectible. And so I think it would be a little bit difficult just reading this paper to say whether a suppression type approach was a non-accrual policy or not for that entity to be able to avail themselves of that guidance. But then I think the bigger place we could struggle is moving outside of the non-regulated entities. And I think this maybe goes back to how John Howard, it might have been you, acting as Chip Curry, who made the comment right sort of at the beginning of this discussion around outside of the regulated space. There is sort of an inference in the paper that non-regulated institutions would get to apply a similar practice if their non-accrual policies are sufficient. I think it would be helpful if we had a little bit more guidance that would be able to help us operationalize what would be kind of a sufficient non-accrual policy, because there's just going to be a range of practices out there where we will have to apply judgment, and judgment's okay, but I think having a little bit more of a decision framework that we could go through on that, and that entities could go through to make a determination about whether they could avail themselves of some of these similar practices, I think would be helpful.
Doug?
To Fred's and Chip's discussion about, keeping our eyes open or keeping our minds open. On the other hand, I think you don't resolve the confusion if you, in this whole pristine interest versus credit loss, if you go the other way and, assume accrued interest and you change all the non-accrual policies and so on to assume that it's more a credit issue than an interest income issue, I don't think that resolves the confusion for the industry. I think that creates additional confusion, and there will still be portfolios or unique loans or situations that need to be handled differently. So I guess I appreciate the staff's analysis on this and the guidance on this. And I would say that, yes, there are some differences in how it's applied, and I'm sure there's differences between regulated and non-regulated entities, but I think in general, from my perspective in the regulated space, people have a pretty consistent view because the regulators have coached us into a pretty consistent view on what's to do with accrued interest and non-accrued interest. And so I think it's relatively consistent. There are some exceptions based on different portfolios, but it's relatively consistent. So I would just make a plea for, let's really think about the impact on the industry of completely changing our focus and going a different way when we talk about accrued interest and non-accruals and what happens to the industry and what happens, as the staff mentioned, to systems and operating procedures and those types of things.
Damon, do you want to summarize or I can? I don't want to put you on the spot.
I would love to.
You want to do it?
So I think at the end of the day, there's support for the View C, but there's also questions of, what, the non-accrual policy that's currently in the call report guidance is, a suggested guidance, and where do we make the cut for non-regulatory entities of, what is similar, also with the student loan example of when we have a lot of interest accruing, when do you actually have to have a CECL allowance? So I think that, overall what I'm hearing is there's support for View C. There's questions out there of how you make, kind of the cut on the non-accrual policy, which I think as we go down the road and look to do a codification improvement in this area, the exposure and the comments that, we're going to have to think about things and do an analysis of what would make sense. And, through the exposure process, definitely welcome the comments that are out there. In addition, I think that, credit cards obviously are, as Shane mentioned, where do we ring fence the credit card issue? Do we change practice that's there today? Obviously, it's similar to kind of the other loans, but there's also it's kind of a hybrid between the two approaches. So something for us to think about and take that away. But definitely appreciate all the comments on it, and more to come on this.
Yeah, I think the only other thing that I would add is that I've noted to incorporate AFS debt securities and not lose sight of how that gets incorporated into any policy election, practical expedient that we would provide in this area. And so we noted that.
I think it's time for a break. Why don't we come back and start at 10:45.
That the approach I think we would prefer is that the $20,000 credit, so to speak, net credit in the example on page 15 be accreted into income as like a discount as well. The other observation is this really does change sort of the model that's used for transfers today, and maybe that's a logical outcome of the new methodology, because they available for sale to held to maturity today is done at fair value, and held for sale to held for investment in the loans is done today at lower cost or fair value, and we're recording these at a different number. So clearly that would need to be understood by anyone making these transfers, that there is that change from current practice. And it wasn't as well highlighted as I thought it could be.
So I guess there's a couple of things. First, I want to go back to John's comment on the differences between HTM and AFS, and I recognize that I think it's maybe paragraph 27 where we described the change, and I think that what we would agree with you, John. I think that what we were trying to highlight is that from an AFS to HTM move, you've booked a credit loss, and so really it's just a little bit, it's just moving from AFS to HTM, whereas the loans is a little bit different in that you've got a valuation allowance, and so it's characterized a little bit differently. I don't know that we meant to establish any kind of threshold, expectation, whatever, what have you, about the differences between AFS and HTM. So that's the first thing. Bob, for your comment, I guess, we're certainly meaning to change the model, and the reason for that was to provide sort of a simple, pragmatic way to move loans from one classification to the other and not create another element of complexity. And so I guess the reason why we have the difference between the loans and the AFS is, AFS was sort of piggybacking off of what is already there today. I've got this piece hung up in OCI and I've somehow got to get it out of OCI. And so we just left that alone. With the loans, I guess, given that you take the full hit of the expense on the day that you take the evaluation allowance, our idea is that you should just simply reverse it and not sort of get into a more complex model of trying to split what's credit and non-credit and hang that non-credit piece up somewhere and kind of, bleed that in over time. But I guess, would you anticipate, if you wanted to take that in over time, separating that on day one and creating a different model going in so that you could align the models going in and coming out? And what I mean by that is, when I take my valuation allowance, would you suggest hanging up that non-credit piece in like an OCI to make that easier to then, when you move back to HFI, to then bleed that back in? Because it would seem to us a little bit more complex that I've taken the full hit on day one, but then get to day two where I'm transferring it back and now having to do kind of a bunch of stuff to bleed that in over time. So I was just curious.
I hadn't thought about that, but I mean, to the extent you're achieving symmetry between the two models, that might be a good outcome. Be a new category of OCI and accumulate other comprehensive income. So I don't know that I'd be opposed to that. I think that the concern was, to the extent it's as if you haven't really purchased this loan at a discount, but you previously had a business decision to hold it for sale, and at least from my standpoint, it was concern about increasing income when just as a result of the decision to change from one classification to another on the balance sheet, which is why trying to achieve the bringing it in income over time, similar to what's done on the AFS to HTM would work. But your approach, if you do it through OCI, if that's cleaner, I don't know that I would object to that. My colleagues might have different views.
Okay. I mean, if
your colleague has different views.
Well, but when people comment on it, if they could just let us know. I mean, it's not something that we really thought about. Again, we thought simplicity, you take the hit, you take the gain, there's going to be something that falls out likely in the end. But Jeff?
So to me, that just sounded more complicated. I think our approach, you'd have that number anyway, right? So whatever you reversed, and then you added to the new allowance, the difference between those two would be what your discount is. I mean, I don't think it would be requiring a lot of complexity, whereas your way, you're actually having to try and split it. This, it would just fall out, right? It would be whatever if your reversal was 100, I think in the example, and then you add 80, 20 is your discount. It's just going to be no net P&L gain on just the transfer, because there's no economic gain there. You're just undoing the fact that you'd recognized it previously.
Okay. Yeah. What? Sorry. Did you have something?
No.
I'm sorry.
Just, we can go ahead and talk about that point. I actually raised my thing for a different point, so I'll wait on that.
Okay. This was for the I have a point. I see. I know. You don't want to lose that privilege. I'm telling you.
Am I on probation?
Yeah.
I'd raise it for a different reason as well, but I'll hold. But let's just talk about Bob and Jeff's point. I actually don't think discount is the right thing to do because you suffered economic loss because you have HFS loans subject to other factors other than credit because you are going to suffer that loss when you sell that loan. Now that the decision has changed, those losses are non-existent from the holder's perspective because you're holding it to the end. So to me, then the loss you book up front is no longer appropriate. Therefore, you should reverse this through P&L right away. I think it's the right way to do, and it's actually the easiest way to do, to build another base to our loan system. It sounds very easy, Jeff, because when you do it on a piece of paper to T accounts, it's not that easy in the system.
Graham, do you have the follow-up?
Yeah, I agree with Jihao on this, and partly because I think the added layer of complexity to the make another discount suggestion is that the way I envision this is, let's say I make my decision on June 1st or June 7th to move something out of held for sale into held for investment. I can know what my mark is there, and I'll flip that out. But I think what you're suggesting is on June 7th, I would have to run an independent CECL calculation on that particular loan or that set of loans for which I made that decision. That's the only way. So I'd have to run CECL calculations mid-period all the time, anytime this happened. And I think that's a tremendous layer of complexity that I'm not sure adds any benefit, because I think the way I envision at least what's laid out here is I would move it into whatever pool it goes to, and when I come to reporting date, I would do CECL. And I think that's very simple.
Mark?
I want to give credit to the staff for coming up with this proposal. This was an issue that we had thought a lot about, sort of, identified and acknowledged the problems, and we'd been discussing it and didn't come up with the approach you're suggesting as a potential solution. But I really like this better than anything else that we had considered. And all of the proposed fixes I think have some drawback, and this one has a little bit of a drawback as well, in that it can create a little bit of P&L noise on reclass. But to be able to get to the point where the loans end up back on the balance sheet with the same CECL reserve that they would have had as if they had originally been in held for investment is a very attractive part of the model that the staff is suggesting. And so then with respect to Bob's suggestion, I do think there's some conceptual merit. I think I probably wouldn't favor that just from a cost benefit and complexity perspective. It seems like if we can have a little bit of P&L noise, but really get the loan back to we're accounting for it as if it had always been an HFI, again, I think is very attractive, as well as staying out of the premium and discount guidance that we talked about earlier in terms of how it relates to CECL, I think is a positive as well. So I would probably keep it the way it is. I don't think these amounts are going to end up being too significant in the financial statements, and so that may be another reason to keep it simple. Also thank you for the comments on paragraph 27. That was something that I think got a lot of interest, and so I appreciate you kind of setting us straight on that. I do worry about posting these meeting materials on the website, long term, because without some acknowledgement of the intent of paragraph 27, because I do worry it could be read out of context. So I don't know how to handle that procedurally, but just want to raise that for thought.
No, I think that your point's well taken, and I think that in the meeting minutes we can actually have a discussion around that particular paragraph, so no one walks away from that paper thinking something that isn't right.
Okay, that'd be great.
Yeah. Jeff? I don't know who's first. Jeff.
Thank you.
You'll probably want to respond to him anyway. So.
I think it ticked him off one side. I don't want to get in trouble with regulators.
Too late. And I'm disappointed in you too, Graham. I thought we'd taught you better when you were a fellow, but no.
It's not the first time I failed. You won't be the last.
No, actually, I think you make a really good point that we hadn't thought about the complexity of that. I think what we were thinking about was the time we mostly see this was when, the whole markets froze up and there were huge amounts of declines and banks wanted to move the stuff. They couldn't sell it anymore and they wanted to move it to stop the bleeding. And so I worry that it could be a little bit material in those times. But anyway, I also wanted to commend the staff because I thought it was a very simple and elegant solution. So you came up with a better solution than anybody else did. So I wanted to commend you for that. And then also wanted to mention that I think that we would support the gross presentation in the P&L. That would be the most transparent. And lastly, while you're cleaning things up, you might take the opportunity to, I thought it was a little bit clunky to read because of the non-mortgage and the mortgage and the way the guidance is laid out. If we could just make it all loans are held for sale or held for investment, I think if that would, and I was even shocked, you were right, Jay, I went back and looked, it talks about other than temporary with regard to loans. I've always thought that as an investment concept. So if we could clean all that up, that would be useful as well, I think.
Yeah.
I'm not going to rebut Jeff. I actually agrees with everything he just said. I do have one point, which is maybe very similar to what Bob made, but maybe the other way around, is about symmetry between securities and loans. So if you look at example on page 13 of 18, in this case, your security is not going back to par, similar to the loan example you had later. But if you look at the 980, that $20,000 difference to par and what's sitting in other comprehensive income, the whole purpose of that is you amortize those simultaneously so you maintain the yield. So really there is no purpose, it's a mechanics. So if you put this back in par and take the unrealized loss out, it really doesn't do anything to your security. And then you get the same model as you have with loans. So actually that was one of the complexity in the old guidance from AFS to HTM, you amortize both of them down. It really is not necessary at all. It's just a mechanics. You can probably take that away and have exactly the same model as loans and don't get a different results.
No, that's a good point, and I think that we can take that on board and take a look at it. I think that we were coming from the perspective of, this has been established. So if this is established, everyone's comfortable with it. How do we move from here and kind of come up with a simple answer? So, but I take your point for sure. Dan.
Definitely, Shihao, agree with your comments there. And this complexity we're accustomed to when you transfer from AFS to HTM, but you could just do away with one entry at the transfer date and end up in the same place, but it is model we're used to. We're also very supportive of the approach outlined in the paper that staff supports and think that it is an elegant solution. It's a simple way to deal with the different models that you come in and out of due to transfers. And one preference we would have is on the income statement to be able to do kind of a net presentation. I guess the fact pattern I was focused on is today what I'm very accustomed to is if I have an impaired loan that's HFI, and one of the strategies I want to follow to work out that loan is to sell it. And I move it to HFS, that initial low-com mark. Everything stays in cost of credit, and the initial low-com mark goes through cost of credit as well on the income statement. And to the extent that there's any subsequent moves to the actual sale price, that would go through other revenue, other expense. But the majority of the cost of selling that loan gets captured as cost of credit, not as, in this model, once we move it to HFS, we're going to reverse out of cost of credit or loan loss expense the amount and then build that through other revenue, other expense. So you kind of, I'm sure there'll be disclosure that's there where you can follow it, but in my view, kind of the net presentation, whatever you've built through cost of credit, keeping that there and incremental amounts going other revenue, other expense make more sense to me. Again, with disclosure, you can bridge the two. So I appreciate some may view a gross presentation having more transparency, but I guess it's just comes from the perspective that you're looking at it.
Chip.
The only point I was going to make when the staff drafts up the language to also consider situations where there's been a charge-off on the loan and whether or not the only thing we're reversing is like allowances, or if we would also reverse charge-offs, just something to pick up from there.
Any other comments, questions? Okay. I think you want to summarize?
Sure. So it seems like most people in the room agree with the reversal approach that the staff recommended in the paper. I think I heard some folks want to have the staff include a discussion about exploring a similar model for HFS loans and debt securities, or follow a similar transfer approach. When drafting the guidance, I think there was a point made about just clarifying the mortgage and non-mortgage, trying to make that easier to read for everyone. Chip's point, we'll consider charge-offs as we go through that. And then I think Gio's point on going from a debt security to a loan.
Okay. All right, I think we'll head on to the next topic, and that one's going to be teed up by Seth.
Thanks, Shane. Okay. Stakeholders have informed the staff that there is diversity in views on whether expected cash receipts from a financial asset that has been written off or may be written off in the future, referred to as expected recoveries, should be included in the calculation of pool level expected credit losses. Because paragraph 326.20.35.8 specifically states that recoveries on written off assets should be recorded when received, stakeholders disagree about whether it is appropriate, or if appropriate, whether it is required that an entity include estimates of expected future recoveries when measuring the expected credit loss for a financial asset or pool of financial assets. It is important to note for this discussion that Memo 11 discusses expected recoveries, which may be different than realized recoveries. Because the differences between these two are not delineated in topic 326, staff received a question in outreach about which recoveries are meant to be included in the roll forward of the allowance disclosure described in paragraph 326.20.50.13. Subparagraph E of that disclosure requires that realized recoveries, not expected, be delineated in the roll forward if applicable. Example 9 of the implementation guidance illustrates why this would be necessary. In the discussion on expected recoveries, Memo 11 identifies key issues for the TRG discussion and discusses the points raised during the staff's outreach with stakeholders. The specific issues highlighted are the following. 1, can all expected recoveries on financial assets be included in the estimate of expected credit losses when assessing pools of financial assets? 2, can all expected recoveries on financial assets be included in the estimate of expected credit losses when assessing individual financial assets? 2 additional questions. Should expected recoveries be included in the calculation of the allowance or directly write up the financial asset at an individual asset level? And also, can the estimate of expected recoveries on financial assets exceed their amortized cost? In Memo 11, the staff discusses the arguments put forth by the TRG submission and outreach participants, analyzes the issues, and provides interpretations and recommendations. To summarize, expected recoveries can and do exist, either because of current write-off guidance, regulatory policy, or changes in facts and circumstances after a write-off. Therefore, the staff believes the board's intent is clear. Expected recoveries on financial assets should be estimated and included in the calculation of the allowance if that estimate is determined to be reasonable and supportable. This view aligns with the high-level idea of capturing an asset's total expected cash flows in the allowance calculation to present the net amount expected to be collected, as expressed in View B in paragraph 11 of Memo 11. Given that this view of including expected recovery is based on a high-level objective of the CECL model, the staff also believes that there should not be a difference between pool level and individual assessment. With regards to presentation, the staff believes that because the estimation of expected recoveries is an input to the overall calculation of the allowance for credit losses that offsets the expected amount of the loss, it relates to the measurement of the underlying asset. Therefore, it should be included as part of the valuation account and not directly write up the asset. However, the staff is aware that there are situations in which the recovery could exceed the individual financial asset's amortized cost basis, and the staff believes that the board did not intend to change practice in how entities operationally account for this situation, or that situation. Broadly, the board's intent has always been to avoid changing practice for write-offs as expressed in excerpts from the basis of conclusions provided in paragraph 21 of Memo 11. Staff understands many entities have historical practices for expected recoveries in excess of amortized costs because this phenomenon occurs today, and the staff believes that current practices do not violate the concepts in topic 326. Rather, these practices are an operational outcome of the overall model for calculating expected credit losses. The question for the TRG is, does the TRG have feedback on the staff's interpretations and recommendations on the issues in Memo 11? And with that, I'll open it up for TRG discussion.
I'll probably be the bad guy in this one, maybe the lone wolf a little bit from the bank industry perspective. I don't disagree with where you guys landed, but I probably would like to soften the wording a little bit. I think this right now said it should be included. I would prefer to have it can be included because one of the reasons you do this is not to disrupt current practice. Not every bank actually include recoveries of a charge of assets in their estimation today. I know maybe those banks are in the minority, but there are banks, quite a few, that doesn't do that. So in order not to disrupt the practice currently, I probably would prefer to say it's can be versus should be. And I think to me this is more of accommodation versus a conceptual discussion as well, because some of the reasoning that was used to support this may not have consistent conceptual basis. So for example, in paragraph 23 in the memo, you said because write-off does not change the expected cash flow from the assets. The assets has to be something recorded on the book, which is why you rejected View A in the capitalized interest discussion. So now we're saying we can reserve assets that's not on the book. That seems a little bit inconsistent. And second, just going back to account statement, I don't know if you have a debit balance in a contra assets. What does that really mean? But in the grand scheme of things, I agree with the results because it doesn't matter as much because it's buried in a big number of allowance. Allowance in overall can never be a debit number. It's always, sorry, can never be a credit number. It's always, did I go backwards? Debit number, right? So it's always going to reduce the assets. So I don't think that's an issue from a grand scheme of things, but just from a practical purpose, I'm supportive of where we're landing, but I'd like to have the flexibility of not including in there because I don't think that's conceptually incorrect either.
How, just a little background, why did some of those entities decide not to consider recoveries? Was it just a conceptual disagreement? Was it to be conservative? Was there some background there?
At least from my personal perspective, it is a conceptual disagreement because I do not believe you should include cash flows from assets you have written off.
Okay.
Mark?
So on the question of recognition, I mean, I think there's a couple of different perspectives on recognition. I mean, it certainly seems to make sense to, in some scenarios we've heard about, to allow recognition. What doesn't seem to be the subject of debate at all is that you would include an estimate of recoveries before charge-off, right? So you'd be estimating losses net of recoveries. It gets very counterintuitive if you come to the point of write-off. You're writing off because write-off is done at the individual loan level. You're writing it, you're writing it off in an amount that is greater than what you had reserved for, and so then you end up having some net P&L. That seems counterintuitive, and so it certainly seems like it makes sense, at least in some circumstances, to allow recognition earlier. I do worry about a broader range of institutions on this and whether or not there will have to be significant changes to internal controls. And maybe a question that I would like to ask is, is this going to be a big control change if you say go over to the commercial portfolio and now you have to have internal controls around surveilling previously charged off loans, right? Because I think under this answer you would need to, right? You would need to surveil all previously charged off loans and develop an estimate of expected recoveries on those loans. And so that would seem to me to broaden the, force companies to broaden the scope of their internal controls in some cases. And I think that may be some of the pushback from a practical standpoint is, that not all entities may want to do that, may want to develop this estimate of recoveries on previously charged off assets. Certainly in the credit card space, I imagine they will, but I do worry about other types of loan portfolios. But I'd probably look for input from the financial institutions on that.
Tim?
I'm supportive of the changing the language where it could be instead of should be, because I think from a conservative standpoint, depending on what kind of portfolio you're talking about and what your actual proven experience is, I can see cases where you have portfolios where you have that as an ongoing thing. But generally, like speaking from a community banking standpoint, you don't really have that. Once you've written it down, and it's over. And then if you do happen to get a recovery, it's a great thing. But to start accounting for that and tracking that, I think it introduces a level in there that you don't really need. So I think if you just allow the flexibility to say if you want, you could. And again, if you're going to prove based on what your experience has been that this is reasonable to do that, that's fine. But I don't think that we should all be starting to have to account for that.
Kevin?
Thanks, Shane. Yeah, so we agree with including the recoveries in the allowance as opposed to direct write up to the asset. I guess on the negative allowance, we certainly agree that you can have a negative allowance. And on the question of whether you can have on a on an individual asset, I mean, it seems so once you buy into the concept of having a negative allowance, you're just changing the unit of account. So you should be able to have a negative allowance on an individual asset as well.
Jeff?
You said you should be able to on an individual? Okay, so we disagree with that. It was hard enough for me to convince my credit folks to allow it on a pool basis, but they're really popping antacids over an individual. And I got the whole, since 1863, we have not allowed recoveries until the cash is received speech. So I think we really favored the language in paragraph 15D that we can accept it on a pool basis. I have a hard time understanding conceptually how I would justify recognizing a recovery on an individual basis. I think about, like today, we want some period of performance before we even allow you to put it back on accrual status. So, just saying, oh, I've suddenly think that guy's going to be able to pay me, I'm going to immediately recognize it. Not comfortable with that. Now, if they start making payments, then I think we could look at those payments as partial recoveries as they make those payments. So we could recognize it then. But to recognize it without any kind of performance was causing a lot of concern from our perspective. We also had some operational concerns. I'm having a hard time just in my head putting together how this is going to be operationalized, since you do charge off at the individual level and recovery on a pool level. And I'm not sure if you're going to have discrete pools or how it would really work in practice. So I would love to see examples of that. We also were concerned about time limits. So the standard doesn't let you recognize credit losses beyond the contractual maturity. And I'm just wondering if there needs to be any kind of guidelines about how long you can look for recoveries. I mean, I think, the farther you go out, the more uncomfortable we would be with that. And lastly is about transparency, just, hiding this debit balance and some big credit balance. I think that we would like to know, what that amount is and be able to somehow gauge how well those cash flows are meeting what was expected to be recovered.
I would just add that I think I knew you were going to make that point because you told me before. But the but that being said, I do think that when we thought about it, I think we thought about it from the perspective of that, the key being reasonable and supportable for everything, and that, for example, we didn't think that someone would write off the asset and then tomorrow say, okay, oh, actually I have this recovery I'm going to collect. But I think, in fairness, we understand your point and the perspective. I think when we thought about all of this, it was in the context of the whole thing has to be reasonable and supportable, and it wouldn't be reasonable and supportable to write it off and to record a recovery the next, for an example, extreme example, the next day. But understand the point that you're raising.
Doug?
Ziao's could is an important concept because as you think about different portfolios, I think you're going to treat different portfolios differently. A consumer portfolio, if you're using a non-DCF approach, a historical loss rate approach, a vintage approach, or something like that, you're probably on a consumer loan portfolio basically bringing in a net charge-off rate essentially, because you're looking back and taking your gross charge-offs and your recoveries and you're bringing those in and assuming a net charge-off rate. So essentially you're bringing in recoveries. If you're looking at a commercial loan portfolio where you have a lot more diversity, you probably don't have as good a tracking around what your recoveries are as you've moved in and out of revolving lines of credit and various other things. It becomes more conceptually and practically difficult to think about a net recovery or a net charge-off assuming recovery. So in that particular case on a commercial loan portfolio, you're probably taking a more conservative approach. And if you're doing some kind of non-DCF approach, you're maybe not including recoveries in that situation. So I think it's important to allow that flexibility. And going back to Wes's point, then I think you are going to have to probably disclose, different portfolios and how you're treating or how you're handling that loss rate and that assumption of recoveries in your disclosures.
Thanks, Shane. Again, I may advance a contrarian view. I tend to think that I think this has to be a conceptually sound answer. I struggle with the practical accommodation of may. I think either we should reach a view that, like Jihao articulated, that if you've charged something off, that's not an asset recognized in your balance sheet, and so you shouldn't have cash flows associated with it. Or I think you should reach a view that it's still an asset, and you should consider all cash flows, including recoveries, to the extent they are reasonable and supportable, particularly in the context of a pool unit of account assessment. I think I struggle with it feels like practical accommodation by practical accommodation is allowing for this wide branching of application. I know it's meant to be flexible, but I think it's got to be comparable at some point as well. So.
Diane?
Somewhat beating a dead horse, but wanted to make sure that you were aware that 32630 references 32620 with regard to write-off. So same thing I was mentioning before. If we change one, we should change the other.
Mark?
Thanks. I wanted to come back and make a little bit different point. If the board ultimately decides to allow the recognition of recoveries before receipt, I would very much encourage the board to consider requiring that those cash flows be classified as an asset on the balance sheet. That doesn't necessarily mean writing up each individual asset, but at least classifying it as an asset on the balance sheet. And I've written down a couple of points why I think this is important. Well, maybe the biggest one is I would imagine, and maybe I'll look to Fred, but I would imagine that the user of the financial statements would appreciate being able to look at the balance sheet and seeing the allowance that relates to the assets that are still on the balance sheet. And if we include a material amount of recoveries, cash flows from recoveries of assets that are no longer on the balance sheet, then you lose that linkage, that natural ratio of the allowance to the related assets. And so I think creating some sort of recovery asset, especially in a portfolio situation, would make sense because it would preserve that link between the allowance and the related assets. My second point is I agree with the comments that have been made earlier. The GAAP doesn't really allow for the contra asset account to have a contra account. I don't think there can be a contra asset. And this would sort of create that, and moving those cash flows out to be an asset once charge-off has taken place, I think would help alleviate that from the standpoint of a conceptual concern. In addition, we have tried hard in the financial instrument space to avoid a lot of netting. I don't think this is netting the same way we contemplated netting in FIN 39 and FIN 41. So I agree that this is an indirect analogy, but still I think we have avoided netting in the past when there's not legal right of offset. And here there is that netting feel from netting cash flows against expected losses from other assets. There is a minority practice of recording recoveries as an asset today. I don't think it's pervasive. I think that is more transparent. I think the staff's view would actually require people to move away from that to actually put it into the allowance for loan losses, which I think is less transparent. reporting. And then the last thing that I want to mention is we started this whole meeting with a discussion of 326-2030-5, which requires expected, using a non-DCF approach, that the allowance would be based on expected credit losses of the amortized cost basis at the reporting date. And of course, in this case, these cash flows are not associated with amortized cost basis that exists at the reporting date. And so reporting these cash flows through the allowance would actually require the creation of another exception to that principle. So just something that I would encourage. Again, I realize that there would be complexity if we say, okay, every individual asset in that portfolio needs to be written back up. I would hope to just sort of take the same accounting we're thinking about applying, but just moving it to the asset side of the balance sheet.
Kevin, did you have a?
Yeah, I just want to comment about, I think what we're trying to do here is we're trying to get an estimate of the losses for the amortized cost basis that we have on our balance sheet. And in order to do that, we use history. And the history of charge-offs and recoveries helps us inform what loss rate we're gonna apply to the existing balances that we have. So I don't see it as being a direct linkage of saying, okay, this cash flow is gonna be used to offset future losses I'm gonna have. I'm saying I'm using this cash flow, both what I wrote off and what I'm gonna get in on recoveries. I'm using both of those cash flows to inform me as to what my expected losses are gonna be on the balances I have today. So I don't see a direct linkage there. I separate the realization of what happened in the past to what am I gonna use to help me estimate future losses I'm going to have on my existing portfolio.
Yeah, but there's two things, if I can speak to that. I mean, there's one thing that says, what is the estimated cash flows I will have on the assets I have on my balance sheet today, inclusive of recoveries, right? That's one thing. But then it's another thing if you add to that cash flows for assets that are no longer on your balance sheet. Like, I understand the idea of a loss rate has to include recoveries to the extent that you have an asset in your balance sheet and you expect both a loss and a subsequent recovery. Both of those should factor into the loss rate. I think my point was more, should you then take that number and change it for cash flows on loans that are no longer recognized?
Yeah, I guess I'm not sure what you mean by take that number and change it, because I have balances and I'm either going to use a net charge-off rate and apply that against the balances, or I'm going to do some modeling, and the modeling is going to show me as I go through time. It's going to provide me, again, it's going to be based on history. It's going to show me, okay, here's losses I expect because of certain macro factors. And then when macro factors improve, I'm going to have potential recoveries on those. So again, all I'm trying to do is estimate the losses I have on the amortized cost basis I have. I'm not trying to specifically identify which loan is going bad and how much I'm going to lose on that loan. It's a portfolio.
Mario, do you have a?
Yeah, I feel like this is an argument about semantics. I mean, you seem to be concerned about whether an asset's been written off to zero or not. And, we can disagree about what the conceptual basis is. I mean, I think the conceptual basis is, do you have the ability to estimate your expected cash flows and understand that facts and circumstances will change? It's not that they may change, they will change. You will have a different view the next day on what you did the day you charged off the asset. And so just because the asset has a zero balance doesn't mean it doesn't exist. It does exist legally. You haven't discharged the borrower from the debt. And so then we're going to get into arguments about whether or not I just charge it down to $1 so that I can continue to recognize those recoveries. So, I mean, I think this is sort of a red herring argument that you've written it down to zero and therefore you can't consider recoveries.
Bob?
I want to go back to Chihao, and I guess Tim both supported this could, and I think that may be another way of getting to the notion of reasonable and supportable estimates. So perhaps when you don't really have the case for what's reasonable and supportable, that's where the could comes into play. So if could language rather than should is potentially problematic in a standard, perhaps there needs to be more color around what really is expected, what are the hurdles you have to meet for reasonable and supportable, particularly for the community institutions where their losses and recoveries may be very sporadic, and to get any historical development, even on a pool basis, may be challenging, let alone on an individual basis. I think building some fences around what reasonable and supportable means and how you have to document and support it, particularly at the individual level, and I know I agree with Jeff really, but I don't know where that's going to go. But we see an extremely high hurdle, much higher than for pools, to establish reasonable, supportable for recoveries.
Brad?
Oh, just a couple of follow-ups. I would just say two things. One is, while this may seem a little bit immaterial to the ALLL, it's very material to the provisioning on a quarterly basis. And so it really does make a big difference. And so the second thing I would say, and obviously while I think we're making a big step forward, we don't want to go back in history to the ability to manipulate the reserve and the quarterly earnings. So that's something hopefully we'll avoid. The second point is I do like the idea of kind of grossing up the asset, or what Mark's point, to the extent, because the other issue that people are looking at every quarter is coverage ratios. And so the extent that we can at least have the most consistent coverage ratios, and that we do incorporate what the coverage ratio is on the asset, that is I very much agree with that. And even when we have reserves for things that aren't on the balance sheet, like unfunded commitments and so forth, at least we have we can calculate a coverage ratio of what that is against. And so I would hate to include things where it kind of messes with the coverage ratio.
Fred, would you need it on the balance sheet, or if it were disclosed as part of the roll forward, included in our overall estimate is X of recoveries? Would that suffice?
I think as long as you can try to get the coverage ratios apples to apples through the disclosures, it's certainly possible. Yeah.
I know I'm the one that originally said could, and just want to give a little bit of support from Kevin and Mario's view. It depends on how you collect data. Like, I think the way that those guys collecting data, which is why some banks are in the minority, is you incorporate the recovery in your calculation of all different elements of loss rate, loss given default, and your EAD. So it's inseparable in a way. So that's why in order to do it the right way, that you guys actually have to include that. It would be very tough not to include it. And although I do like the conceptual soundness of assets because the coverage ratio is skewed, but the problem is if you do that, then my next question is, what about my other gain contingency? So this one gave a little bit early recognition of gain contingencies in the assets. So then I have to go back and revisit all the other ones as well. So although I like it, the idea Mark and Fred was raising, but conceptually it's not jiving with the rest of the gain contingency.
Sorry, Dan?
I wonder if part of the challenge here is, in thinking about credit cards, we have a full write-off at 180 days past due, and that's what's pushing us into this space where we have some folks uncomfortable from a conceptual standpoint. And probably, folks that are very focused on those portfolios don't think that it's entirely appropriate to write off 100% at 180 days past due or whatever the time period is. But that's a whirlwind from a regulatory requirement. It's very standard, across the industry, and there's disclosures surrounding it. But that's what's kind of pushing us into this space, is that we have to do a full write-off. But yet there is significant historical, information and statistics on the levels of collectability that continue, after that point in time. And so the fact that we're doing a full write-off to then have to kind of disembed the information on anticipated recoveries for loans that have been charged off versus those that have not, to create a separate asset. I think how much additional transparency is that going to bring to the process, from an understanding of what's going on? That's all included in the measurement of collectability and the allowance that's established today. So I'm not sure that it will, from a cost-benefit standpoint, be tremendous for additional transparency.
Doug?
To Mark's point, I think conceptually and theoretically I understand that point. I guess I make a plea again for the thousands of small financial institutions who are also impacted by this, and our hope is to kind of reduce the complexity for the implementation. And if you add a recovery asset or create the concept of a gross up, that just adds complexity in terms of operational procedures and systems impacts to a lot of small institutions where disclosure is not necessarily as critical. So I would ask the staff and the board to keep that in mind as you think about that. And conceptually, I understand completely that that would make sense. I just think operationally, again, it becomes challenging for a lot of institutions who have or who are already struggling with how do I implement CECL, and they're very familiar with historical loss and net charge-off and using that concept or using a gross charge-off on commercial loan portfolios or so on. So to add something else into that consideration becomes more challenging from an implementation perspective.
Doug, how do you respond to Dan's observation that part of the issue results from a mandate to basically charge off 100%, regardless of whether you think it's going to be 100 or 20%?
Yeah, I think Dan's point is a good one. I think that's relatively unique to credit card portfolios. So again, I think basically you're going to have to take the credit card portfolio and you'll figure out your strategy and what's allowed in the guidance and provide disclosure. So I can see the whole industry separating that credit card portfolio out and providing specific disclosure on that. I think in most other situations, you probably won't have too many situations where you end up with this negative or this debit allowance account, because I think when you're thinking, for example, in a commercial loan, if I'm writing off the whole amount when I really think that it's only I'm going to be able to recover something, I'm probably making mistakes in judgment to write off the whole amount, or I'm being absurdly conservative in that respect. And generally what you see in practice is I've got collateral worth this much, my loan balance is this much, so I'm going to write off, the difference basically and do a partial write-off. And I'll have adjustments based on when I actually sell the collateral, but I won't have that situation like I have with credit card receivables where basically you're forced to write off the whole amount and then come back and recover.
Chip.
We've spent a fair amount of time trying to think about how, in response to your question, different charge-off policies, and inevitably we kept running into the same problem where this issue is going to rear its head. So if you take, building off Dan's example with credit card, on average you might expect to collect 20 cents on the dollar, just make up a number. But on an individual loan basis, the one thing you're sure is you're not going to get 20 cents on the dollar. It's either going to be a lot or zero. So we started exploring the operationality and what would happen if we were to charge off to a different number. And what we kind of concluded is, because we'll never know, right, what the right number is, and because the portfolio is this averaging, when actual recoveries come in, it's going to be different than what you charged off. So you're going to run into this negative allowance issue, whether you're charging it to 0, 20 cents on the dollar, fair value of collateral. So our experience is, an answer to your question, is it's not necessarily because of a regulatory mandated issue that causes it. It's just any charge-off policy where you're going to actually adjust the amortized cost base without perfect vision as to what's going to happen. I think this issue comes up.
I was actually going to make a very similar point to what Chip had just made, but I think the final thing I wanted to say was I thought Kevin and Mario hit the conceptual issue on the head here. I think to Mario's point, the way I thought about this was, okay, if I can't think about recoveries on an amortized cost or a loan that's completely written off, I'll charge it off to a cent, and then I can't. And that just seems like a silly answer, and I don't think it communicates meaningful information. I think as I've understood the board's intent, it's been to put an allowance on the books that takes that pool level loan portfolio and reduces it to what I expect to collect. And it doesn't give granularity into the individual loans. And so I think that pool level concept should be maintained. So I think I wholly agree with the staff. I thought they hit it on the head.
Yeah, I think, the tension here is because charge-off policies are on an individual asset. But I think the pool basis, one, gets us to losses earlier, right? Because if you had to look at each individual one, you would wait for triggers. And so to me, it's just narrowing to the more realistic outcome. We're going to recognize losses maybe earlier on a pool basis, but then if you think about recoveries on a pool basis, you're probably not going to go down as far on a charge-off. So I think it is semantics. I think this is, theoretically, it's hard to say I should have a zero asset and a negative allowance, but that's just where we're at because this is a pool notion, but charge-offs are an individual asset thing, which don't impact the cash flows at all. Not 1 cent doesn't impact your cash flows, doesn't impact your rights to still collect. And so I think recovery should be considered on a pool basis. And I would hope that this struggle of can't have a negative allowance doesn't make us say recovery shouldn't be included. They should be. And I don't know how often this would even show up where it's going to be material that I have a negative allowance. It could happen in a segment in some kind of disclosure. And I think we just need to be comfortable that the balance sheet is in the right place. And I think you should be thinking about recoveries.
Yeah, probably, John, maybe going back to the same maybe parsing the words, it's should or permitted to be. I think it's permitted to be, and it's the right thing to consider for certain institutions. But if I want to record my recovery on a one-off basis as other income, it should be allowed as well. I don't think these two are mutually exclusive at the end of the day.
Well, it might be what you think is reasonable and supportable, right? And
Yeah,
so
yeah.
I think without even using the word could, you could just say, I don't think it's reasonably supportable to have those if you want to. I don't think this would preclude you from having that.
But I can.
policy.
This is a slight difference. Though. Even if it's reasonably supportable in the recoveries, the way that I'm tracking recovery today, which is on charge of loan separate basis, then I should be allowed, even if it's reasonably supportable, to baked into the data to calculate pool-based allowance. I can still record them on a loan-by-loan basis. I don't think that should be precluded.
Wes?
I would just weigh in that reasonable and supportable from my perspective requires some discipline. It's not optional. And so I think there is a difference between a permissive policy versus a requirement to have a reasonable and supportable approach that really isn't, sort of an optional, a policy option.
Any more questions, comments, concerns, or just want lunch? All right, with that, I think we're gonna go ahead and actually do a summary, and then we'll break for lunch. Apparently, I want lunch.
I don't want to stand between Shane and lunch, but so I think the key thing I think that we heard was the conversation of must be included, could be included. I think just so everyone's aware, in terms of meeting minutes and if there was any drafting changes, it would likely be may or can. You generally don't use could, but just so people don't question it, we're meaning it to be the same thing if we discuss it that way. And then I think there was a point around what to do with cash flows. Should they be classified as an asset from a recovery perspective? That point was brought up. And then the point about individual assets and should that really still be when they're realized as opposed to expected. And the transparency, which I would equate to the disclosure around the individual assets. And I think more broadly around how you're thinking about recoveries. And I think the last point was around 32630 references and just making sure we're being consistent with 32620. Hopefully, I think that's pretty much everything. I think lunch is in the dining room, the board dining room for the TRG members, and everybody else, about an hour?
Yep, and we will be back, reconvene at 12:45.
All right. Thanks.
Okay. We're a minute early, but I think that's okay. We've got our last session. I know people have got flights and other things to consider, so let's go ahead and get started. Shane?
Yeah, so I think that our next memo is memo 12 on refinancing and loan prepayments, and Jared is going to tee that up for us.
Thanks.
Stakeholders have informed the staff that there's diversity in views on whether entities are required to use the loan refinancing or restructuring guidance in paragraphs 310-20-35-9 through 35-12, what I'll refer to as the loan modification guidance, to determine what constitutes a prepayment for the purposes of expected credit losses measurement. GAAP provides a framework for assessing whether refinancings with the same lender are new loans for purposes of determining recognition of fees and other costs in the loan modification guidance, but does not provide specific guidance in Topic 326 to assess whether these events are prepayments for the purposes of estimating expected credit losses. Therefore, some stakeholders have asked for clarification on this issue. Memo 12 discusses the arguments put forth by the TRG submission and outreach participants, analyzes the issues, and provides interpretations and recommendations. The TRG submission presented two views detailed in paragraph 7 of Memo 12. View A would require an entity to look to the loan modification guidance to determine if a refinancing is an extinguishment of the original loan and therefore a prepayment for CECL calculation purposes. View B would not specify a particular framework for determining prepayments and would instead leave the matter to professional judgment. The staff believes that, consistent with View B, entities should not be required to use the loan modification guidance to determine what constitutes a prepayment. However, the staff believes that an entity should not be precluded from using the guidance if the entity determines the guidance provides an appropriate basis for determining prepayments given its specific portfolios and facts and circumstances. As outlined in paragraph 23 of Memo 12 and the preceding paragraphs, the staff reached this interpretation because, first, the board did not consider a specific definition of prepayment during the deliberations on the amendments in Update 2016-13, and that term was not discussed in connection with the concept of a new loan under the loan modification guidance. Second, the loan modification guidance is for the purposes of recognition of new loans, not the measurement of credit losses. Only after an item has been recognized is it then measured. These are separate processes. Third, Topic 326 generally does not define specific inputs to the calculation for credit losses. And fourth, there would be significant costs and cross-cutting issues if entities were required to use the loan modification guidance. The question for the TRG on this issue is, does the TRG have feedback on the staff's interpretation and recommendation on the issue in Memo 12? And with that, I'll open it up to the TRG for discussion.
Sarah.
We'll kick you guys off here. So just two general comments. As regulatory bodies, we discussed the topic and we agree with the staff's recommendation to allow judgment in this place. I think one other comment that we actually wanted to make was that, kind of borrowing from Wes's comment, procedural discipline. So to the extent that the institutions choose to use, I think ASC 310-20-35-9-12, make sure that there's proper documentation supporting how you got to those conclusions and calculations and things like that. We would love to make sure that there's discipline in the way that gets documented, but generally agree with the recommendation.
Mark.
I think the reason this issue came up is because I think some institutions, a lot of institutions, were going down a path of considering the new loan guidance for some products and not for others. And we were worried about that inconsistency, and the support for considering it in one way for one type of loan and another way for another type of loan was very well grounded in some of the economic considerations and some of the perspectives of credit risk management professionals and things like that. But I think there was concern that that entities or auditors would get criticized for not applying a consistent policy across an organization or a consistent accounting interpretation across an organization. And so my understanding of the paper is it sort of leaves us with its judgment, but it doesn't really say what to base that judgment on, right? It just says, hey, it should be judgment. And so, one alternative would be to just sort of build out a little bit more what those judgments should be based on, and make sure that there are things that can be subject to internal controls and auditing and things like that. But My suggestion is, would we be able to just tweak, I think, a little bit the staff's suggestion and just make it, a specific accounting policy election that would be applied consistently at the portfolio segment level. And just sort of take the judgment part out of it, unless somebody can really articulate how those judgments would be applied. I mean, would there be objections to just making it an accounting policy election and say you can freely choose to consider the new loan guidance or not consider the new loan guidance, and you can make different elections for different portfolio segments?
I guess I'm looking forward to hearing what the institutions have to say, but I guess where the staff came from on this was why would we pick this particular input to ring fence or call out an accounting policy election or define or tell you what your professional judgments should be when we don't do that for things like reasonable and supportable. We don't do that for other elements of the model itself. And so on balance, where we landed was we don't do that for other places, and it would seem very inconsistent from the board's position on this to start doing it in this particular area. And so that's why we didn't consider what you're suggesting.
Was thought given then to how judgment should be applied in this case, or just that judgment should be applied?
I think that once you start going down the road of saying how judgment should be applied, I don't know how you don't then branch into telling an institution how judgment should be applied in every instance of the model. And the board acknowledged that we're not risk management professionals, we're not modelers, this isn't our business. And so we provided that flexibility within the standard to allow people to use their professional judgment. And even with estimates today, the board doesn't say how one should apply judgment. So that's where we land.
Yeah, I totally support the view B. And I think when, at least from the regional bank space, when you think about the modeling that we're going to be using to come up with the estimate, a lot of the models have prepayment assumptions built into the modeling. When it's the mortgage models, there's well-defined prepayment speeds and things of that nature that go into the models. And then on the commercial side, which is a little bit more difficult, we do have internal history on prepayments, and we've incorporated those into the models. Those models have been validated by our model validators, and so they're accepted within the models as being appropriate prepayments to consider. So from our perspective, within these models, it's workable for us, and it gives us the flexibility because it's a little different. Commercials are different than the consumer models, so we have that flexibility. I think works out really well for us. So.
Great.
Yeah, thanks, Shane. I think I agree with the staff's analysis. I think one thing we've noted is that a lot of entities, particularly down the food chain in terms of size, may not have a lot of their own prepayment information, but may be using market information. And I think we think those definitions of prepayment are fairly consistent amongst products or within a product type. But I think to provide a definition, there would be an incremental step then of saying, okay, say I'm acquiring third-party data, is their definition of prepayment consistent with the new definition? If it's not, we have to work backwards and to have comparability and figure out. It would add a layer of complexity that I think sounds like it wasn't intended. Beyond that, I think that if they're going to, I think we had, as Jared mentioned in his excellent opening remarks, I think there are cross-cutting issues. For instance, in hedge accounting, I think if you define it for this purpose, is it going to be the same definition of prepayment for every purpose? So it almost seems like a standard setting issue if you're going to define it. It's not just a tech correction. is prepayment for this, prepayment for hedging, is it prepayment from a debtor's perspective?
I also agree with the staff's analysis and recommendation on this, and with Kevin's point there. I think this adds another layer of complexity again, and we caution the board about complexity for smaller institutions. But I also don't, as I think about practically how you would consider this per se, I don't know how much it would really apply. How would you really focus in on this specific issue when you're looking at your projected prepayments, because you're making an assumption about your prepayments anyway based on whatever historical data you have or whatever other reasonable conclusions you can draw. But then you have to go to that next level of saying, does it meet the 10% standard or not? And it seems like you're going down this rabbit hole of already making generalized assumptions about the future and then having to go down to a very specific rabbit hole of, does it meet the 10% test or not, when the whole thought process is conceptual and you're making the assumptions. I don't know if it adds a whole lot of additional value in the process anyway, given the overall, uncertainty about the assumptions you're making.
Nothing else?
Thanks, Dan.
We don't want to leave too quickly here, but I'm not going to fill up the next 3 hours, so a collective sigh of relief. We very much are in sort of support of UB and think the staff did a great job, articulating the support for that for different types of fact patterns and loan portfolios. I know, in the corporate loan space, for us, generally the vast majority of prepayments occur are the internal refinancings, and I think that's driven by that market segment, for us and what the borrower looks for, and when they're coming, if they've got a 5-year bullet loan, they really want to continue to have long-term debt classification and so forth. So that really encourages, striking a new loan or amending and extending the loan when we go through an underwriting process and so forth. I think our risk people have generally looked at corporate loans, not, at least today, we don't factor in prepayments. And when we've got a 5-year bullet loan, even though we're expecting an internal refinancing to happen maybe 18 months before it matures, we very much look at it as a 5-year credit. And so there's no interest in trying to imply, a probability of default based on a 3.5-year life, because it's, historical statistics show that it's going to have an internal refinancing at that juncture. And so, I think our risk folks very much in the corporate space would prefer to, the vast majority are these internal refinancings and just go with the explicit, tenor of the loan itself. Now, if you go in and look at the statistics and you find that's true for 90%, but the other 10%, they are true prepayments, and then maybe you need to factor in something, if it's reasonable and supportable along those lines. In the consumer space, for the reasons you've articulated, I think it's often, very different, the activity of the marketplace, the economics of what's going on, and the likelihood of having internal refinancing is much lower, and there's a lot more market pressures that are coming to bear there. But, to apply the 10% test in that model that's there to determine whether or not it's a prepayment from a measurement standpoint seems not a lot of value add, very burdensome, certainly not something that's really done today. And so we support the conclusions and the flexibility that's in the staff write-up.
Mario? So really just to reiterate some of the things that Dan has said, I think we think about commercial lending similarly, more in sort of the amend and extend. There's a reason why the loans have initial short-term maturities. It gives us the opportunity to go back in and re-underwrite after a number of years. And so we think about that instrument as more from a relationship perspective versus I'm going to refinance it in 2 years. So it's really a 5-year loan, which, kind of raises the whole, can you consider extensions beyond the original contractual maturity issue? But we're not redebating that issue, but, we would think of that as a 5-year loan. In terms of fee recognition, sort of the fee recognition process is separate and distinct from the credit risk management. So whatever we're doing on the accounting side of the house to figure out whether we have a new loan or not, to see if we can recognize fees or flush costs, is separate from how our credit risk folks think about that. And their processes are just not connected. And that's a mixed bag of qualitative assessment. Did I re-underwrite? Is it a market rate? To some folks may actually run the actual quantitative test. And I would say that, and this is probably true for a lot of organizations, that 10% test that people are running probably isn't being run right or correctly. They're probably just saying, oh, well, I had a $100 million loan. Now it's $125 million. Well, that's more than 10%. That's a new loan. But if you actually run that through the test, it's not going to be a new loan. So that's why I'm concerned about, any process where we say, let's use that 10% test to determine whether or not we have a prepayment, where I think if you think about the loan more from that 5-year relationship and the expectation that the borrower is going to continue to renew with the cap at the contractual maturity is a better model, and it's more consistent with how we manage credit. And we manage the life of those loans on what I would call an attrition-based model. Is the borrower around or not? And does the borrower around mean they've refinanced, or they paid off, or they defaulted? And so if they continue to refinance, then you always have that sort of original contractual maturity as your lifetime for your allowance estimate.
Any other comments, questions?
Going once, twice, sold.
All right. I think that if you want to summarize.
We could summarize pretty briefly, I guess.
Just because we did it for all the
yeah,
others.
just to be consistent. And for those on
It would seem weird to not for this one.
Yeah, so it seemed like there was largely, agreement with the staff recommendation. I think, from Fed and some of the other agencies' perspective, I think for those that are going to refer to the 310, 20, 35, 9 through 12 guidance, potentially making sure you apply support and judgment for that and documentation. I think there was another perspective around, should it really be more of a policy election, and should there be some more clarity around some of those judgments? So we can take that back as well. But it seemed like there was largely support for the staff recommendation.
All right. So before we wrap up, I want to take a second, one, to thank everybody around the table. Really appreciate the feedback you've given us, and those that participated in our outreach. Again, it's a really big part of our whole process. And I personally would like to thank both Seth and Jared. They're going to be leaving us, and Seth is going to be heading back to PwC, and I think Jared is also going to PwC. And so they've been a really big part of what we did for the last couple of years, and also in preparation for the TRG. So I just want to say thank you guys, and good luck. And just a brief review of the process. So if you're kind of wondering where do we go from here, the staff will draft up meeting minutes for everything that you've heard here today. The staff will then share those meeting minutes with the board. The board will provide feedback to us. We'll adjust the minutes. Once we get through our internal process, then we'll send the meeting minutes out to all of you, and all of you will have a chance to comment on those meeting minutes as well and provide feedback on those. Once we get all of that taken care of and address all of your comments, then the meeting minutes will be posted to the implementation webpage to supplement all of the memos that are already posted there today. For those things that we've said we're going to make codification improvements on, we plan to start bringing those issues back probably in the third quarter of this year to start going through them. That's really the best that I can give you at this point. I will have a better update at, say, the AICPA banking conference. We can let you all know kind of where we stand with those issues, how many issues we've already covered, how many are still left to go. So We are very cognizant of the fact that you need to get this stuff locked down, taken care of, because you want to start doing parallel runs as of 1/1/19, particularly for the public companies. With that, I'll turn it over to Hal to wrap up.
Keep this short and sweet. Thank you very much for all the time and effort. I apologize for giving you 3 hours of your day back, but the meeting is adjourned.